have this idea that we could see a downside to growth and that we could see more weakness than people expect with ongoing stickiness to inflation. I mean, that kind of sounds like dreaded stagflation.
Yes,
is that kind of where you're going with this?
It is, and it's one of the things, that we've kind of said is sequencing will matter. We expect that we're going to get a barrage, literally a machine gun of policy proposals, right? You guys, as journalists, are accustomed to the 10 headlines a day, and he tries to figure out, okay, which 4 stick of the 10, and then he goes with those 4 and another 6 the next day. Our best guess is that barrage is going to create a level of noise that does undermine some of that animal spirits and creates uncertainty for the other 60% of the economy, the low-end consumer, the smaller cap companies, because they can't figure it out. And so I think it's that we're going to see early in the year. There's an unbelievable, sense that, hey, consumers are going to get tax cuts. No, they're not. Not in 2025. Where it's going to be on a derivative basis, on the first and second derivative or the rates of change, right? Your taxes are going to be exactly the same in 2025, right? There's no tailwind, right? That's all coming in 2026.
And this is the reason why, in some ways, you're advocating to unwind some of the Trump trades that people have put on. Can you talk about which you think are most vulnerable to the reality check of sequencing, to the reality check of the delay of how long it will take to implement?
So look, I think that, some of these Trump trades have been so staggering, it's almost obvious. The cryptocurrency trades, up 50% in 50 trading days, extraordinary. We have, Tesla, similar type of move. I think some of the small cap move has begun to fade, in the last 10 days. Our best guess is that the fading of that small cap trade is what reflects this potential stagflation. That, hey, wait a minute, everything's great, but maybe it's not great for us, because we're still, broadly in a set of unprofitable companies that have, struggled to deliver upside surprise in earnings.
So do you still like gold?
We still do like gold here, and for us, the gold story really is about inflation and dollar debasement. It's a lot about this debt and deficit story. Again, the bond market has sniffed out this joke. And on various days, you see, some folks trying to express a desire for term premium in the long end of the curve. Our best guess is, as these debates get underway, the debt and deficit storyline is going to have to.
So do you think
get higher profile?
We're at the peak dollar right now?
I don't know if we're probably close to peak dollar. But look, I think a lot of things are at play here, and one of the things that I think is a profound risk, again, this is not a market that's pricing many risks, but we have an extraordinarily bifurcated currency market around the world where the dollar is strong versus virtually every other currency. If, in fact, we come out on day one after the inauguration and are extraordinarily aggressive with China, I think that there's a non-zero risk that China could come back and say, okay, we're devaluing. A devaluation of the renminbi would be hugely destabilizing across the global trade complex. And, those types of risks are just not being priced right here. So, is the dollar at peak strength? I'm not sure. But I think we're getting close, and we're just at this very fragile and unstable place.
If someone were to hear everything that you put together, they would say, wow, what a raging bear. Oh my God, you must be predicting 4,200 for next year and year end.
No, not at all.
Okay, so let's talk about why not, because basically you're talking about debasement of the dollar and the end of the Trump trade and stagflation. So give us where you really are with this.
So look, I think that there are risks out there that we want to see priced. At the same time, there is value because this is an extraordinarily bifurcated market. So we're saying that this is going to be an environment where there are winners and losers. So we do see some winners, right? So we see financials, we see domestic industrials, we see portions of consumer services that, again, are domestically based as big winners here. We recently upgraded mid-cap growth companies as areas. We've built some diversification. We're owning, Japan. We're owning some parts of emerging markets. So we think that there are things to do out there. We think that this is a index that next year can chug along at the index level and maybe give you 5 to 7%. But at the same time, what we're saying is if you're getting 5 to 7% in a stock market that is extraordinarily richly priced on extraordinarily ambitious expectations, why not own a better risk-adjusted return in an investment-grade bond and clip the coop and just, make it to the end of the year?
You mentioned EM. What do you like in EM? Which parts?
So we've been long bulls on India. We know India has stalled out. We think Mexico is way oversold, and that by the end of the year, we're going to find a better footing there, and some of the tensions with the U.S. Will be mitigated. Brazil, obviously, now significantly tightening. We believe that that's going to get priced and that there's going to be opportunities, to buy some value in Brazil.
I've got the foreign exchange screen in front of me. Year-to-date emerging markets. It's amazing. The peso in Mexico, down 16%. In Brazil, the currency down by more than 20%. Likewise in Argentina, go up to Russia, down 13%. In Hungary, down 11%. Colombia, down 11%. Double-digit moves in foreign exchange in EM.
You have to wonder at what point you hit sort of a bottom, given the fact that you have a lot of potential trade wars being priced in.
Yeah.
Lisa Shallett, it's good to see you, as always.
Great to see you.
Appreciate your time. Thank you.
Thank you.
Lisa Shallett there of Morgan Stanley. Equities this morning on the S&P 500 at the moment, near session highs, up a third of 1%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Scott Bassett, Trump's pick to run the Treasury Department will meet with Democratic Senator and frequent Wall Street critic Elizabeth Warren today. It's part of a series of meetings he's having on Capitol Hill ahead of his confirmation hearings next month. He will meet with several Republican and Democratic senators today, including outgoing Majority Leader Mitch McConnell, Texas Senator Ted Cruz, and Oklahoma Senator James Lankford. The head of Tesla's China factory is leaving the company, according to people familiar with the matter. Song Gang, who oversaw construction of the company's Shanghai factory, will leave this week. Song joined Tesla in 2018 as the first employee of the EV maker's first factory outside the U.S. And the Milwaukee Bucks are the 2024 NBA Cup champions. The Bucks defeating the Oklahoma City Thunder 97-81 in the championship game, led by an MVP performance from their superstar Giannis Antetokounmpo, who finished with 26 points along with 19 rebounds and 10 assists. The Bucks bounced back to win all 7 of the tournament's games after starting the season 2-8. That's your Bloomberg Brief. John?
Yahara, thank you. Is anyone watching this anymore? NBA, basketball?
Okay. I think the WNBA took the oxygen out of the room.
That's your argument?
That's my argument. I think Caitlin Clark, single-handedly.
Yeah, remember those tickets were so high?
Yeah.
People were preferred to go see her play than
that's
some of the men.
That's my take.
Okay, I'll
and
take
I'm
that
sticking
theory.
to it.
I'm happy to move on without challenging it. Up next on the program, avoiding a shutdown for now.
We worked really hard to achieve consensus on a bill that responsibly funds the government into March of next year. We ought to try to pass this on a rule to go through regular process. We're committed to all of that. We're going to take care of these obligations and get this done.
That conversation up next. Live from New York this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Snapshot of the price action right now. Equities at the moment up by about 1/3 of 1% on the S&P. On the Nasdaq, up by 1/3 also. On the Russell, up by 0.6. Big focus on the breadth of the S&P 500. How many stocks are advancing versus how many stocks are declining? You mentioned Jim Reed of Deutsche Bank a little bit earlier this morning. Jim Reed noting the 12th day in a row where the number of decliners exceeded advancers within the S&P 500. Lisa, he's made the point that this is the second longest run in 100 years and has only been exceeded by a run of 14 days back in 1978.
It's pretty shocking to think, what does this mean? Normally when you get narrow breadth, it makes people nervous because what that means is only a couple stocks are holding up the entire index. Lisa Shallot was talking about how small caps rolling over indicates that fear of potential weakening growth. On the flip side, you could say it just indicates the strength and the preeminence of a number of names that are fundamentally changing the landscape for technology.
So should you be worried? Jonathan Krinsky of BTIG saying the breadth collapse has not been confirmed by credit spreads. Over this period, credit spreads have been tightening. They've not been widening. So is there something to worry about for the broader economy? The credit market, for at least for now, says no.
And basically, a number of the notes that I was reading, and honestly, we've been hearing this from a number of different investors. If anything, it sets up for a buying opportunity next year. And that's essentially what we heard from Julian Emmanuel earlier, that essentially this is just selling the news and then resetting before an early 2025.
I mentioned credit. Let's turn to fixed income just briefly. Take a look at the Treasury curve, 2-year, 10-year, 30-year. Yields a bit higher this morning by a single basis point on a 10-year. Let's call it 440.66. Under surveillance this morning, avoiding a shutdown for now.
We worked really hard to achieve consensus on a bill that responsibly funds the government into March of next year. We've been working around the clock to get the CR done. It was intended to be, and it was until recent days, a very simple, very clean CR, stopgap funding measure to get us into next year. We ought to try to pass this on a rule to go through regular process. We're committed to all of that. We're going to take care of these obligations and get this done.
So here's the latest this morning. Congressional leaders reaching a deal to avoid a government shutdown with a stopgap bill set to extend funding through mid-March. House Speaker Mike Johnson bracing for pushback from House Republicans with the bill's disaster aid funds totaling over $100 billion, opening the door for further infighting. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, how much opposition does this stopgap bill have in Washington, D.C.?
Yeah, good morning, John. I was actually on Capitol Hill yesterday where we felt that growing discontent among Republicans when it came to this stopgap measure, despite their leader, House Speaker Mike Johnson, being the one to negotiate it. And I spoke to one senior Republican aide for a member of Congress that we are expecting not to vote for this bill, who said that it's mainly the lack of pay-fors for this additional supplemental funding that is tacked onto this bill that is the largest sticking point. Now, you mentioned there, perhaps most notably, the $100 billion in disaster relief funding for Americans that are still reeling from the devastating hurricanes that happened over the fall in the southeast U.S. Of course, that was part of a bipartisan push. President Biden had asked for that money back in October, but we're seeing a litany of other issues be tacked onto this bill, including $10 billion in economic assistance for farmers, even potential curbs to U.S. investment in China. And in one interesting move, the bill actually paves the way for the Washington Commanders football team to relocate their stadium from Maryland back to the nation's capital. So the bill is anything but a clean CR that you heard House Speaker Mike Johnson say was their original intent. Now, despite that, we are widely expecting this bill to pass. They don't want to stay here past that Christmas holiday or set up a government funding fight right ahead of the inauguration, but it does do two things. It likely sets up a government funding fight just months into President-elect Trump's new term, particularly as Republicans try to cut back on what they are calling bloating spending. But before any of that happens, it also poses a potential challenge to House Speaker Mike Johnson, who's campaigning for the gavel again, and that will happen on January 3rd.
Tyler, Elon Musk doesn't like this, and he's making that very clear on Twitter this morning, saying it shouldn't pass, and then he's posting a photo of how big the bill it is, this monstrosity. You're hearing people say Merry Christmas, everyone's getting a stocking stuffer in this bill. Do you think he has real weight when it comes to whether or not this passes?
Right, of course. Well, we do know, as you've been reporting, he's going to head up the Department of Government Efficiency, which will look to cut some of this bloated government spending. But we are heading to likely another battle next year as the Trump administration lays out its priorities that likely will actually add to the deficit, including his proposals for tax cuts next year. One Bloomberg analysis showing us that if all of his tax cuts are passed, it could add $10.5 trillion to the deficit, besides some of the positive economic benefits that his administration is hoping to push through and convince Republicans in a unified government to pass. Now, when it comes to Elon Musk, we do know, of course, that he has been advising President-elect Trump, and that as many of these CEOs head down to Mar-a-Lago to meet with him, this is going to be one of those issues that comes up, how corporate spending, government spending is all going to be intertwined in a new Trump administration.
Well, when we looked ahead to 2025, we still have a number of Trump nominees on Capitol Hill, meeting with senators. Interesting enough, Scott Bessent, his Treasury pick, is going to be sitting down today with Elizabeth Warren, and she hasn't been too warm and welcoming of him thus far. How testy could this exchange get?
Right, Amory, you had that great reporting this morning on the terminal that that meeting's going to happen. Of course, importantly, Senator Elizabeth Warren is going to be the ranking member on Senate banking next year. And as somebody who has interviewed Senator Warren dozens of times on Capitol Hill, of course, she is known as one of the biggest foes of Wall Street. But also, I'm kind of interested to see if maybe there is any common ground here. For example, we know that she has worked with at least one member of the incoming Trump administration, and that's now Vice President-elect J.D. Vance, when he was a senator on Senate banking. The pair teamed up on that executive clawback compensation bill in the event of a bank failure. So that could be one potential area that perhaps she could see her more populist message break through. But as your reporting showed, this is likely to be particularly contentious, and of course comes on a day of a big Fed decision. And we know Elizabeth Warren herself has proclaimed herself a foe of Jerome Powell's.
Tyler, you've been making the commute from Washington, D.C. to Mar-a-Lago. How crowded are the planes from D.C. to Mar-a-Lago?
Right, we're seeing everybody flock there. Of course, we have the reporting that most of these CEOs, including Jeff Bezos today, will be heading down to Mar-a-Lago, but it extends beyond that. Other names like Mark Zuckerberg and also Sundar Pichai, Tim Cook, all in the last week going down there to meet with President-elect Trump. And I was talking to actually one Republican strategist about this who said it's actually it's a pretty good operating procedure, right? Since we know that President-elect Trump often will reverse course when it comes to his critics if they're willing to cut a deal and perhaps give him a political win. All of these CEOs, for the most part, have shown some sort of criticism or perhaps didn't outright endorse his campaign. And we're sort of seeing a pattern emerge from these meetings, right? One, of course, is that they're going down and they're having this FaceTime in person. That appears to be absolutely critical. They're not doing this over the phone. And the second appears to be donating to his inaugural fund, using that money as a commodity to show their support in that way. I was actually interested by this. Just quickly, we know, of course, the Amazon CEO, Jeff Bezos, going down there. Amazon has pledged $1 million to Trump's inaugural fund. I looked up the FEC filings from last inauguration. At the time, Amazon gave about a quarter of that to Joe Biden's inaugural fund, $276,000. That seems to be underscoring this point that there is going to be a unified government in Washington next year. It's not just Trump one, but that there's going to be more policymaking with Republicans controlling both chambers of Congress.
Tyler, that's Bidenflation. That's what that is. Tyler Kendall, down in Washington, D.C. Appreciate it. Tyler, thank you. This came from John Carney, the team over at Breitbart. Looking forward to the reaction from Mar-a-Lago to what happens at the Federal Reserve. Trump world fears Fed cuts may stoke renewed inflation.
That is interesting. So basically, this idea that maybe Kevin Warsh's hawkishness will be welcome.
Let's see what we get from New York. This is Bloomberg.
The countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures this morning positive across the board on the S&P 500, the Nasdaq and the Russell. Equity futures on the S&P in their session highs up by about 0.25%. Likewise on the Nasdaq, some outperformance on the small caps, on the Russell up by 0.66. With 2 hours until the cash open, let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Every nation likes to create their own national champion, just in different forms at different times. This time, we're talking about Japan. This is the ADR for Nissan. Honda, we understand, pursuing a merger, certainly not going to be a merger of equals. Honda worth $44 billion, Nissan worth $8 billion, with $1.6 billion worth of bonds to recapitalize next year. But this is about the pursuit of financial expediency, political expediency, and how to survive in the world of electric vehicles coming from China. Some of the reporting is Nissan, senior officials saying we're fighting for our lives, 12 to 14 months to survive. Either way, you've got a maturity wall, as I say, of around $1.6 billion. This is about the politics of survival of your auto industry on the world stage. That's what you're seeing writ large here. By the way, Honda is down just over 3% in the ADRs. We wait for the ADR print to come through in the US. NVIDIA is bid this morning. Again, lovely story. Microsoft reaffirming the narrative that Microsoft does scoop up NVIDIA chips in size and in quantum, 485,000 of them, to be very precise. The next biggest order on the ticket dock is Meta at 224,000. This is all from Omdia collating the data on that. So a little bit of a reprieve for NVIDIA. General Mills, you get your Haagen-Dazs, you get your Lucky Charms, you can get your Nature Valley bars. They have lowered their guidance for the year. Why? Because of the uncertain macroeconomic backdrop. I'd love to be a PR person to write these things. Uncertain macroeconomic backdrop, higher investment levels. I mean, bottom line is they're holding up in North America, but it is a fairly defensive sector to be in. To try and win market share in this area is proving tougher and tougher. Jonathan,
are you a Nature Valley bar kind of guy, Manus?
That is a bar of sugar, and you know that's banned.
Carbs free.
Carbs free.
Manus. I know. I get it. He's not a Nature Valley kind of guy.
He's a big carbs-free guy. I think I introduced him to even what Trix was because they started putting them upstairs in the pantry.
I remember back in London, this is a long, long time ago, and the show would begin at like 6 a.m. London time, and you'd start to smell fish coming from the set because he would eat fish before the start of the show.
Or grilled chicken because no carbs.
Yes, no carbs.
Okay.
He would eat fish.
He hasn't seen a carb since the 80s.
All I can say is you guys took that somewhere so different. I didn't even realize Haagen-Dazs was General Mills. And I love Haagen-Dazs. So I am just going straight for the junk as you guys go toward the purity test of, the nature,
some people
Valley
might
nature.
consider Nature Valley to be
Nature Valley?
Junk too.
I just embrace Haagen-Dazs, which is actually really good
Different
quality.
story.
I like it.
I wanted to get to this story because I know it's your favourite.
It's my favourite for that.
The quote of the week so far. Under surveillance this morning, Canadian Prime Minister Justin Trudeau attempting to downplay the resignation of his finance minister. Trudeau telling a Liberal Party gathering, quote, wait for this, like most families, sometimes we have fights around the holidays, but of course, like most families, we find our way through it. I love you guys, and love is what families are all about.
I can't even.
It's better when you see the video, and hopefully you can find the tape a little bit later, but honestly, ridiculous.
Honestly, it's fantastic. And I got to say, kudos to the Bloomberg News headline writers. Trudeau tries to brush off deputy's exit as festive family spot. This isn't going to win him any points with the electorate, who are probably going to vote him out of office, considering the fact that everybody can see that she was frustrated with him. She didn't want to release her budget. It was the day she was supposed to release her budget, and she quit because she didn't agree with him.
Not just the electorate in Canada, his own party, the number of lawmakers and the Liberal lawmakers calling for his resignation has grown to 45, with one saying he's delusional. I was speaking to Josh Wingrove yesterday, who's our resident expert Canadian, works in the White House team, and he said, I was trying to explain to people in America how big of a deal that this finance minister decided to resign on that day, and the scathing letter she wrote. He said it would be basically, you would have to imagine Kamala Harris coming out and resigning the day Joe Biden was giving his State of the Union. That's how seismic of a shift this was.
It's really well framed, and couldn't agree more. More on Canada a little bit later. Let's turn to Uber. Uber joining the list of tech firms donating to President-elect Donald Trump's inauguration fund. The rideshare giant and its CEO, Dara Khosrowshahi, each donating $1 million alongside the likes of Meta and Amazon. According to CNN, Trump is set to meet with Amazon's Jeff Bezos a little bit later on today.
So the better question to ask is, who isn't donating? Because everyone is going to be donating to the inaugural fund. What we are just hearing about are companies that are willing to come out and say, yeah, you should put my name out there that I also gave $1 million. Industry-wide, the list is very long, and we just really are hearing about the tech world. But it'll be interesting to see what banks are donating and what other companies are also making sure that the president-elect knows that they're giving to his inauguration.
This is the question I have for you. What's this money going to go toward? Is it going to be just some kind of spectacular? Will there be just
inaugurations are expensive?
Well, okay, but I want to know, what is this spectacle and how significant it's going to be? Because I think that kind of sets up.
Lots of parties, lots of security. I will come back with a list for you on potentially exactly what they're going to be budgeting for with this money.
Does Doge itemize that list for us?
Doge.
To get a breakdown.
I mean, if they're trying to Dogify the government, maybe they should pull back.
Dogify the inauguration.
Yeah, Dogify the inauguration.
Let's turn to this one. The Defense Department saying the mysterious drones sighted across the Northeast are not being flown by the Pentagon. Major General Pat Ryder saying officials take seriously any cases of drones flying near military sites, but adding they aren't a concern given the volume of daily drone flights.
This is not comforting to me. It's sort of like a game of charades where it's not from the Pentagon. Is it from the Army? It's not from the Army. I mean, basically, why don't you tell us rather than signaling what it potentially could be? There seems to be an explanation that some of the authorities just don't really want to share.
Well, when we heard from General Ryder, he said it is possible that some of those are surveilling, absolutely, but you can make the assumption in every case, not necessarily. So again, left me with more questions than answers. PG&E, I thought was fascinating, the CEO this morning saying how many drones they have to make sure that they're looking after their infrastructure. And you can imagine a lot of companies are doing that. But if the U.S. government has the information, just tell people, because people are starting to talk about that they want to get these drones out of the sky themselves, and people should not be taking these type of measures into their own hands.
Yeah, that's not what we want to see. I think we want some answers quickly going into the weekend. Let's get you some stock news. Micron reporting after the closing bell, the chip maker looking to be the latest firm to benefit from the surge in AI demand. Anna Nikolaevsky is the founder and CIO of long-short firm Axel Capital Management and has been betting on the name since 2023. I'm pleased to say that Anna's with us now. Anna, good morning.
Good morning. How are you? Thank you for having me.
It's good to see you. It's been a great year for some chip makers, but not all.
True.
It depends what you're exposed to, PC, smartphone, data centers. When we talk about Micron, what kind of exposure are we talking about?
I think at the moment, people are expecting the quarter to have up ASPs in the 5% range. I think the ASPs going forward may actually be flat to down, and you're probably not going to see a recovery until the back half of 2025 because there's going to be a little bit of a push out for smartphones and PCs at the moment.
What is it about the back end of 25 where you start to get a better tailwind for those kind of businesses?
There's going to be a replacement cycle.
Across smartphones?
Across smartphones and PCs, I think at the moment you are not seeing 100% adoption by the consumer of AI PCs. I think Best Buy has hired several thousands of people to help train consumers on the AI PCs, but there's no major uptake right now for the Christmas season, as far as I'm hearing. So there may be an uptick later on next year when there's a natural upgrade cycle for enterprise and consumer.
What's fascinating to me is that people have been trying to pick the next NVIDIA, the next big winner from the whole chip cycle, and the fact that we've seen some real massive winners. Broadcom seems to be the latest superstar. We've just seen this moonshot in the shares with them falling right behind Tesla as sort of the Magnificent Eight, and people are playing around with what the name could be. What gives you confidence that Micron's growth has that type of moonshot at a time where people are trying to imagine what the sort of evolution of AI adoption looks like?
I think when I think of Micron, I think of DRAM, I think of a global commodity that is actually going to be benefiting from some of the US chip stimulus. But I think long term, you're going to see more and more DRAM across the board, and everything memory is extremely important. So I think about Micron in terms of that long-term cycle that right now probably is going to decline a little bit, but will come back up again later. Although last year, Micron was telling us that 2025 will be the peak. So it's a function of what overall tech adoption will be like in terms of hardware.
When you talk about your investments, you're investing on the tech side with Micron, but you're also very low tech with respect to just what people buy every day, maybe some of the Nature Valley bars that some people like, and Haagen-Dazs that some people like and enjoy.
Is that a staple?
Actually, in our household, it is a staple, and we go through a lot of bars.
For many households across the United States of America.
And that's okay.
That's what they want to hear.
Some people grow up on Lucky Charms and turn out just fine. But I will just say, Anna, how much are you really going towards some of these staples, and why now?
We've taken a very conservative approach to investing right now, where we have large holdings in BJ, in Costco, in Walmart, across the board. One of the reasons for that is we're trying to go to where the puck is going. And at the moment, we're seeing a slowdown in AI adoption. I think we're seeing the opposite of the FOMO that we saw in the beginning of last year, where managements were virtually throwing money at GPUs. It was all about speed and scale. And this year, I think we've seen a significant transition in terms of how are you going to monetize this AI? What is it going to cost? What is the must-have app? And what is it going to cost on a long-run basis to operate the AI once you get past the training part?
But these names, Costco, Walmart, Target, it's where you can find good deals.
Precisely.
Do you see a slowdown in the consumer?
I think we're seeing a slowdown in the consumer already. I went to buy some coffee the other day, and a pack of 20 Starbucks K-Cups cost me $40. So I think that everyone's kind of migrating towards cost saving, but I'm literally thinking about what's going to happen to the S&P if there is a slowdown in tech. Where will that money migrate? And to me, the money is going to migrate towards more conservative, stable cash flow generating areas of the market. That being said, I think that Trump is 100% pro the market, and he's surrounded by extremely smart people. I think very highly of Scott Bessent. I think Elon Musk is one of the greatest innovators, just beyond this generation, obviously, maybe of all time. So I'm very impressed by the team that he's assembled. But that being said, I think that technology is on a cycle of its own, and we're seeing changes in terms of focus ROI. We're looking at intellectual property and security issues to consider, and also in terms of AI data governance also needs to be addressed.
You've been super gracious with your time already this morning, but this is not the reason you're with us. You're with us because you're participating in the Robinhood stock picking contest, whereby you have to pick one long and one short and see who wins over 6 months. We can put the leaderboard up on the screen. Can you share with us your long and short and what's behind each one of those picks?
So my long is BJ, just primarily generates a lot of cash flow. And I think that if GDP does slow down, I think the stock will be pretty resilient. My short is in technology. As I said, I think you're going to see a slowdown. I think right now, when you're looking at prices of GPU rentals, they've come down pretty considerably because there's a lot of server optimization. And once you've stopped trying to train your AI, you may have excess GPUs that now you're starting to re-rent to other people. So now it looks like there's a lot more competition on the GPU rental front. So longer term, that's extremely positive because it's going to lower the barriers to entry for new companies to come to train and create new business models. But in the short term, that may create some pressure for data centers and the chip manufacturers.
That is fascinating to me. How much do you think that that is underappreciated right now? I mean, that sort of speaks to the short position. Why do you think that's overlooked?
I think the CEO of Microsoft mentioned it last week when he said there's no longer a chip shortage. I think we were chip constrained for 18 months, but I think that started to resolve itself probably in the middle of this year. And now I think volumes are coming to the market, and you're seeing a large reseller market. You're seeing supply come onto eBay and Alibaba of entire GPU clusters, which is going to depress pricing.
And it's all for a worthy cause, so it's good to see you. And thank you for sharing that with us.
Thank you so much.
Thank you very much. That was Anna Nikolaevsky there of Axel Capital Management. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Staying on chips, the U.S. is said to be gearing up to initiate a trade investigation into Chinese semiconductors in the coming days. Sources say the review could result in tariffs or other measures to restrict imports on older model chips and the products containing them, such as cars or smartphones. The investigation could take months to conclude, with any reaction left to Donald Trump's incoming administration. Meanwhile, President-elect Donald Trump has chosen football legend Herschel Walker to be ambassador to the Bahamas. Trump made the announcement in a post on his Truth Social. Walker most recently had an unsuccessful run for a Senate seat in Georgia. To hold the ambassador position, Walker will need his nomination approved by the Republican-led Senate. And struggling automaker Nissan is in merger talks with Honda. The deal would create the world's third largest automaker. Talks between the two companies accelerated after iPhone producer Foxconn approached Nissan to take a stake. Nissan's troubles came to the forefront this year after the company slashed its profit forecast and revealed plans to cut 9,000 jobs globally. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the Fed bracing for Trump.
We don't know what the timing and substance of any policy changes will be. We don't guess, we don't speculate, and we don't assume.
We don't guess, we don't speculate, and we don't assume. I imagine you might hear that again a little bit later on this afternoon. From New York, this is Bloomberg.
case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They're pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
House Speaker Mike Johnson making some comments to an American broadcaster just moments ago, Fox News, saying that Elon, Vivek and I are in a text chain together as the House and Congress looks to pass a stopgap funding bill through the end of the year and into 2025.
So 2 things. They're basically like us. John, Lisa, myself are in a text exchange. But also, why is Elon Musk then going to Twitter saying, I don't agree with this bill? Speaker Johnson needs this bill to pass. Maybe just tell him first in your WhatsApp or Signal group chat.
But the 3 of us aren't passing quadrillion-dollar bills, are we?
No, definitely not.
And one of you is not the Speaker of the House. Maybe one of you will be in the future. I've got no idea.
What kind of emojis do you think they use?
Lots of robots.
I don't want to know.
Robots, for sure, and American flags. Definitely the top 2.
Probably. What do they think about this bill? I think we're already getting a sense of that Elon Musk doesn't really think much of it.
No, he thinks he's trying to Dogify the government, so he doesn't want to see this Christmas tree bill where a lot of money is being thrown on it, including pay rises for lawmakers.
It's very difficult to change the ways of Washington. Really, really hard, and we're going to see that play out over the next few weeks, I'm sure. Equity futures right now on the S&P 500, positive by 1/3 of 1%. It's Fed decision day. In the bond market, yields are up by a basis point or 2. The 10-year 4.41. Under surveillance this morning, the Fed bracing for Donald Trump.
We don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
So here's the latest this morning. The Fed expected to announce its final interest rate decision of the year and deliver its latest summary of economic projections ahead of a very uncertain political future. Joining us now to speculate, to guess, to assume is the former St. Louis Fed President, Jim Bullard. Jim, welcome to the program, buddy. It's good to see you. Can you speculate on next year? You've lived it. You were on the FOMC for the first Trump term. How different is this second term, Jim?
Well, I think it's a big advantage that we have seen this movie before, and so the first time around it was more uncertain. I think this time you kind of know the MO for President-elect Trump, how he operates, the kinds of things that he'll consider most important. And I think for markets, you know, it's basically a pro-business administration, and that carries a lot of weight.
Meanwhile, Jim, we're talking about the potential for signaling into next year. How far do you think that this Fed chair is willing to go at a time where the market really has pretty low expectations for how many rate cuts are next year? Can he or does he want to get ahead of them and signal a potentially even more restrictive stance?
Yeah, I think the dot plot is going to do the job for the Fed here, and the dot plot is Wall Street either thinks 3 or maybe 2 is a median number of rate cuts for next year. Those will be spread out over the year, so that's going to dovetail with the story that much slower pace of rate reduction. They've come on with this meeting. They will have come 100 basis points in just 3 meetings. It's going to be nothing like that next year. And I think it'll set up a clear case for pause, high probability of pause in January. And that'll give them the March meeting, and then they can sort of look around at the March meeting and see if they want to go further or not. And that will depend mostly on the inflation data at that point.
Jim, do you think that they are concerned about the fact that since they cut by 50 basis points, we've seen a steadying out and actually an increase in longer-term yields, the sense that maybe inflation is going to be stickier next year? If you were still on the Fed, would that concern you?
Yeah, I maybe have a different view as always, but I think that the normalization of the yield curve, that 2 years less than the 10-year now, is the last piece of the soft landing story. And so I think this is exactly what you would want to see if you had a successful soft landing. You've got growth, I guess Atlanta Fed GDP now over 3% for the fourth quarter. You've got unemployment close to the natural rate by most people's estimates. You've got inflation way down from its peak and above 2, but trending toward 2 in 25 and 26. Normalization of the yield curve is the last piece of that. So I think it's all very healthy in my view.
Jim, I'm sure you won't mind me saying this, but many years ago you made a mockery of the dot plot of the Federal Reserve by planting your dot at the very bottom all the way out. Now, Jim, I just wonder if you had a dot today, how different that dot might be. Think about the long dot. How much do you think is going to change over the next few months relative to what we've seen over the past few years? Does that long dot need to keep coming up?
Yeah, I think it is going to come up a little bit more. I think the committee's been more bullish. I didn't like the long dot part of the dot plot because that's the thing you're most uncertain about, and it kind of anchors everybody's thinking. So. And I think what happened during 2009 to 2019 is that you were in this low real interest rate, low nominal interest rate, low inflation regime. And the pandemic was big enough to knock us out of that regime globally. And now you're back to something closer to the 2000 to 2007 period, or my favorite period, the late 1990s. And so the real rates are higher. So I think that's pushing up the whole interest rate structure, and I think that's what we're going to be looking at over the next 5 years.
Jim, there's a common theme on the FOMC. The only difference I see is in degree, not in kind. They'll say things like, we're a long way from neutral, so we can keep making a move here. Jim, when they say things like that, what's guiding their view on how far away they are from neutral?
Yeah, and the median of the committee thinks neutral. The neutral Fed funds rate or the neutral policy rate is 3%. And you need about, depending on how you calculate it, another 100 basis points on top of that to combat the fact that inflation is still above target. So that gives you 4% as a ballpark. And of course, there are opinions around that, higher or lower. But where the committee is today, coming into this meeting, is too high for that. So that's why they feel they've got comfort in making this move today. And then they'll be able to sort of get some more data over the next 90 days and see what to do next. But they feel pretty comfortable, I think. And I'd be comfortable making this move today.
Jim, making the dot plot great again. It's good to see you, sir. Enjoy the holidays. Jim Bullard there, the former St. Louis Fed president. Can we close that gap between where the Fed is on neutral and where the market is?
Stop reading my mind. That's what I was going to say. Make the dot plot great again. That's essentially what we're looking at here.
Do you remember what Jim did all those years ago?
What? Yeah,
I love that.
I love that too.
Putting the dot right at the bottom, just making a mockery of the whole thing.
But he's fallen back in love with it.
But he was right back then.
Right.
To do what he did. We kept projecting higher interest rates going back to where we were before, and it wasn't happening.
Now it's
until the pandemic.
Yeah, and then it shook us out of that.
Things changed again. Up next, we'll catch up with Victoria Fernandez of Crossmark Global Investments, Greg Peters of PGIM, Jonathan Pingle of UBS, Priya Misra of JP Morgan. The third hour of Bloomberg Surveillance just around the corner.
other thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Fed might stay on hold.
Pause. There is a question about what the Fed should do.
Unpaused. How much longer?
Okay, we can start again. But meanwhile, I just think that there's a sense that the Fed should consider maybe not cutting 25 basis points based on the fact that you're seeing this incredible dynamism and a number of record highs and no sign that there's really restrictive financing conditions. At the same time, why would they surprise the market when they have been saying repeatedly that they're far away from neutral, especially when they are setting up for some sort of pause? They don't like to surprise the market, and it seems like that's likely again today.
I think what it speaks to, though, is potentially what we will see on the FOMC is that some individuals are going to come out and say, maybe we shouldn't be cutting. And we know Jerome Powell, it's like herding cats. He wants to speak with one voice when it comes to the Fed, and potentially he's not going to have the backing of everyone when he comes out and greets the press.
The overwhelming consensus is that they cut interest rates today and then they skip in January. But we'll see what we get. We'll see what we get in January as well, because so much of this for 2025 comes down to changes to policy in your world, Anne-Marie. Lisa, whatever happens in Washington will dictate a lot of things we talk about through the next year and beyond.
And that's the reason why some people are looking for scenario analysis, which they're not going to give. They're going to say we're just completely dependent on the data that comes in and the policies that come out. Interesting, though, to see where the emphasis is. I'm sure that there will be questions about what the most inflationary potential policies are, whether it's tariffs, whether it's immigration, and potentially some of the restrictions there. Again, more scenario analysis, so get ready for a lot of that this
Just
afternoon.
get the script out. We don't guess. We don't speculate. We don't assume.
Yeah, but he can't do that for everything.
On repeat.
Yeah, I don't know.
Well, he could, but it'll be boring, so I hope not.
That'll be the news conference later. Tune in, 2:30 Eastern Time. Coming up, Victoria Fernandez at Crossmark, looking ahead to the Federal Reserve. Greg Peters of PGM on why the FOMC can meet its 2% inflation target. Priya Misra of JP Morgan on why she's expecting 3 rate cuts next year. We begin this hour with stocks higher ahead of the final Fed decision of the year. Victoria Fernandez at Crossmark saying the problem is that both sides of the dual mandate are heating up. The question comes down to, is the Fed still restrictive? And according to Powell, the answer is yes. Victoria joins us now for more. What's the answer according to you?
I don't think we're as restrictive as the Fed wants us to believe. I mean, you look at growth, you've got Atlanta Fed GDP now, 3.3%. You've got inflation. We had CPI and PPI reports come out. Big revisions there, inflation being sticky. And you have really high sentiment right now. Look at NFIB, small business, 3-year high on sentiment. You've got bull-bear ratios. Very strong on the bulls. Now, that can be a contrarian signal. I get that. But you still have really strong sentiment that is out there. With these elements, I don't know how you can say this economy feels restrictive. I say, yes, there are underlying elements, right, under the surface that I think will start bubbling up, but I don't think it will be until early next year.
But isn't that disconnect just super bullish? So long as the Federal Reserve Chair thinks they're restrictive and keeps cutting interest rates, isn't that just a green light just to keep on buying?
It is for now, and I think that's why you're seeing the market continue to move up. Yes, the past few days we've had a little bit more volatility in play, but the market is going, and you've got the seasonality along with it. You've got earnings expectations that people think, I think a little optimistic, but double-digit growth again next year in earnings. You're not having the labor market completely fall apart. So I do think there's elements that are tailwinds to this economy, and you add Powell in, which I know you said you think it'll be boring, Anne-Marie, but I do think he's going to come out and say the same. We're data dependent, recalibration, blah, 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 and everyone's just going to look to the dot plot, regardless of what Jim Bullard said earlier. They're going to look to that dot plot and go, what are you really thinking?
I don't think it's going to be boring. I think it's going to be fascinating, and I cannot wait for the meeting and the dot plot and the press conference afterwards, in particular, because as you're saying, this is a tailwind, essentially the idea of a Fed cutting. There is a question of for what assets? Is it a tailwind for stocks? Is it a tailwind for bonds at a time where you have a real discussion, longer term, about whether this actually increases the chance of stickier inflation over 2025 and 2026? What do you expect to be the reaction in the bond market, particularly at the longer end, should this be a Fed that does lean more dovish than, say, what the market is expecting?
Yeah, if you get a more dovish feel to the press conference, I do think you'll have equity markets rally a little bit, and bond yields will probably come down, at least in the near term. I think they come down a little bit with the expectation that the Fed will continue to cut. However, bond vigilantes are not going to be happy with that. So let's give it a little bit of time. I think they'll come in, they'll start singing, and we'll see yields move up intermediate term from there. But the initial reaction, if the Fed is dovish, I think you'll see yields come down a little bit.
That raises this question about whether the market does not believe inflation to actually be a real threat. I mean, which is it? It seems like there are different messages from different asset classes. In the bond market, it seems like there isn't a great deal of concern, but it's definitely a sense that things are stickier. And then the stock market, they're just saying, we don't care. If it's mildly inflationary, that's great. Let's go.
Right. And there's other elements that could cause inflation to go higher. It's why it's such a difficult story right now. I mean, we don't know what tariffs are going to do exactly. We don't know what kind of corporate tax cuts or individual tax cuts are coming in, and is that going to be inflationary? I think the key to a lot of this, though, is productivity. That can really be the element that comes in and buffers inflation and helps growth move higher. So if the expectation is that you're going to get some productivity coming in, maybe that's one reason why the markets are not as concerned right now with what inflation is saying.
Well, Jay Powell won't assume what Trump 2.0 will look like, but the market certainly is. What sectors do you think will do well next year?
Well, a lot of it depends on the policies that we see come through, but I think you can imagine we'll probably have CapEx stronger going forward. If you have federal spending come down, that helps on CapEx. It helps corporations in regards to margins. So I think you'll see industrials do well. I've liked financials all year. It's been a story we've had. I think you'll continue to see financials do well. They've had a little bit of consolidation, but you have that deregulation story coming in. You have a positive yield curve. Loan growth should grow. M&A should grow. So that gives you some bumps there on financials as well. We don't invest in crypto, so I'm not going to say that, but it's been going a little crazy there.
You like industrials because potentially the tax rate story, right?
Tax rate and CapEx, I think we continue to see grow in onshoring.
But what about tariffs?
Yeah, I mean, I think we have to separate the tariff story out, and you probably know better than I do when we look at the history of this. I think when you're talking about tariffs as it relates to China, that's one story. I think we can assume that that's going to be pretty quickly. After January 20th, we're going to see some movement there. When you're looking at tariffs for the rest of the world, I know there's been a lot of talks in the conversations with Canada and the conversations with Mexico, but I think that's a different story, and I wouldn't anticipate we're going to see those come to fruition as quickly or maybe as high a level of tariff is what we're hearing right now.
Let's talk about breath. Bad breath. We've been seeing a lot of bad breath over the past 12 days throughout the entire month of December. And it raises the question, is this a taste of what's to come next year? Or if this basically is just a breather of the Trump trade and it will reassert itself come 2025? Where do you fall on that?
I think we do have to be a little bit concerned here. I know we're having a little revival here and tech names are doing well. Yes, NVIDIA's pulling back, but Broadcom's stepping in. So we're seeing those go. But then you look at how much concentration there is in these names. I mean, top 10 names are 38% of the weight of the S&P 500. So you don't have that diversification. You're seeing a little bit more breadth down cap, but I think we have to be concerned when we hit next year and you have the debt ceiling crisis come in and we start to see tariffs go into play. I think we have a little more volatility next year. I don't think this is just a small pause and then we're going to go full on bull market from here. I do think there are some concerns that we have to be leery about.
What's the hedge at a time where there's equal risks of both some sort of acceleration in inflation or a downturn?
For us and for our clients, it's really being diversified. So not just in your stock picks that you have, but yes, we want to be in the market. You've got tailwinds going right now. I mean, path of least resistance is higher for now, so you don't want to ignore that. You want to be in that market. But we like those areas we talked about. Put some names in financials. Look at some of the industrials, longer-term play. You know I'm a fixed income person, so I think you still lock in some of these rates. We maybe go up to a 4.75 or so on the 10-year. I think you can lock that in because with global rates as low as they are, I mean, you look at Germany, you're like 2.5, right? We look and see what's happening in China. I think you can capture some of that as well and have some exposure.
The SNB talking about how negative rates do work. Do you like anything when you're looking at diversifying outside of the United States?
It's tough right now. I would have said a few months ago, yes, put your toe into Europe. I think that they're going to start to see things with the ECB cutting rates. But the issues that we're seeing out of France, the issues that we're seeing out of Germany, the poor manufacturing there, I mean, we have it here, but it's even worse there. We're seeing a 230 basis point differential between UK and German 10 years. I think you have to be concerned. I need to see a little bit more positive movement coming out of Europe before I think you go there. And Asia, I think, you know, there's some concerns there in China as well. domestic demand is really slow. We saw it in retail sales. They had the highest month of outflows, like 46 billion last month. So I think there's some concern there. I think you got to stick with the U.S. for now.
Disinflationary, deflationary traps are difficult to get out of. Japan lived it. Europe went through it for a while. Are we seeing that start to take place in China? Is that what that chart of Chinese government bond yields is all about? Is that what it says?
I think that's part of it, but I also think when they're looking at tariffs that could be coming, you see some flight out for that reason too. There's some concern. You have China saying that they're going to be more proactive in regards to the stimulus that they put forward. They upped their federal deficit. They're saying it's going to be 4% now next year instead of 3%. Not a huge move, but they're trying to do some things. There is somewhat of a trap there you have to be leery of.
Bond market doesn't believe them. Looking at that chart, doesn't believe them at all.
And neither do a lot of other people. I mean, there is sort of a sugar high in the equity markets, perhaps, but realistically, are they going to be able to juice growth at a time where consumers are reluctant to spend? That ultimately is the question.
Victoria, good to see you. Great to catch up. Thanks for being here. Victoria Fernandez there of Crossmark Global Investments. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. The Biden administration releasing a study that may complicate President-elect Donald Trump's plans to quickly approve more exports of LNG. The study found that increasing exports of liquefied natural gas would raise natural gas prices for domestic consumers and lead to an increase in global emissions. The report said currently approved LNG shipment amounts are enough to meet global demand for decades to come. Meanwhile, Grubhub will pay $25 million to settle allegations by the FTC and Illinois Attorney General that it deceived diners and drivers. As part of the settlement, the FTC said the online food ordering company will stop adding junk fees, give a simple cancellation method for Grubhub Plus, and notify customers if their accounts have been blocked. Meanwhile, according to ESPN, two-time WNBA champion and three-time league MVP A'ja Wilson is signing a 6-year contract extension with Nike. Wilson's deal, according to the report, is among the highest-paid shoe endorsements in women's basketball, alongside those of Indiana Fever superstar Caitlin Clark and Liberty standout Sabrina Ionescu. Wilson has a signature shoe releasing with Nike in spring 2025, prior to the start of the WNBA season. That's your Bloomberg Brief. John?
Shouldn't they be writing thank you letters to Caitlin? Shouldn't everyone for the extra money they're making?
Well, and then there was a controversy over the cover. Was it the Time cover that had her? Was that the one? And people were saying that she shouldn't have been on there by herself. It was the entire WNBA.
My goodness.
Anyway, but just want to say thank you to whoever put that in the brief to prove my point that that's taking the extra.
We all agreed with you. Yeah. That's why NBA ratings are down.
Thank you. Yeah.
It's not because they're all sitting there trying to shoot three-pointers all the time and the games have got boring.
No, it's
totally about the NBA.
100%.
Who's your favourite player from New York Liberty? Okay, up next, the morning calls, plus Greg Peters of PG as we count down to the final Fed decision of the year. That's next. This is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
No more basketball. Equity futures on the S&P up by a little more than 0.25%. Let's get you some morning calls instead. First up, Bank of America upgrading Expedia to buy, citing signs of improving US travel trends. That stock is up by 3% in the pre-market. Your second call from Baird, downgrading Rivian to neutral, noting the uncertain landscape for EVs in the near future. That stock is down by 1.3%. And finally, Morgan Stanley raising its price target on Netflix to 1,050, forecasting another strong year of advertising growth in the United States. That stock is up just marginally. Just hours away from a Fed rate decision and updated SEP. Greg Peters of PGIM writing, our base case continues to see inflation as gradually easing towards the 2% target, with a Fed funds rate eventually settling in the range of 3.5 to 4% in 2025. This may also indicate that the Fed's long-run projection for the Fed funds rate continues to rise. Greg joins us now for more. Greg, welcome to the program. Let's start where you left off. How much does that long dot need to rise?
I'm not sure about need, but I think there'll be continued pressure on the rate market repricing that longer-term dot, right? So I think it's important to remember that that has changed over time. That adjusts with the cycles. And I still think in many investors' minds, we're stuck in this past cycle, this very low growth, low inflation cycle, and I don't think that's the one we're at currently.
So, Greg, that's destination. Let's talk about pace with the destination in mind. There's going to be a different cadence. I think that seems to be the takeaway for a lot of people. It started at 50. We've gone 25 at each meeting since then, again today expected. Greg, how do you think that changes through next year?
Yeah, so I think the market pricing is actually pretty on target. One of the issues that we've had over the course of this year was the aggressive pricing throughout the course of this year. It seems more rational, currently. So you have basically a done deal for today, and then only 50 into next year. So maybe there's some scope if the economy does decay for that to pick up. But on balance, it seems pretty rationally priced to me. And makes much more sense today than it did, let's say, 4 months ago.
Greg, Deutsche Bank put out a note this morning that I keep going back to, and I've repeated it several times this morning, that this has been the third year in a row that markets have had a more restrictive or overestimated how much the Fed was going to cut rates in the following year. And I just wonder, given the fact that we have seen rates stay higher than many people expected, and that we've still seen outperformance from equities, if there is a really strong message about just how high neutral is right now that you're taking to heart.
Yeah, so I mean, the markets are stuck in the past, right? I mean, one of the issues that we've had, quite candidly, is this whole Fed stepping in at any drop of the dime. That's an outdated playbook, right? So we're facing a different battle. That battle is inflation. I think the Fed understands the credibility that comes with being an inflation fighter. So I think the snap reaction that any sign of weakness or wobble that the Fed's going to come in doesn't make much sense to me. But if you think about neutral, I actually think about neutral as a range. 4 to 2.5%. So let's get to 4%. I do believe, though, that the policy rates currently that are set globally are for a different regime as well. If you look at, when policy rates crested, inflation was already coming down. So I think we have to get to neutral. And to me, that neutral is a starting point of 4. So let's start with 4, and then we can revisit.
Greg, is the implication here that you actually see a much greater degree of disinflation in the global market than people currently appreciate?
Yeah, inflation is a tricky one. I do think, we're on a path, a pretty sustainable path or a steady path, I guess is a better way to say it. But I think what the markets are pricing in currently and what fixed income traders are starting to fret is that this inflation trend will not only stall out, but reverse. And so some of the weakness in the bond market that you're currently experiencing is that concern that inflation might not be as under control, particularly here in the U.S. As we initially thought. So I think that's the risk factor. That's what you're seeing in the pricing currently, I think, and it's something to watch out for.
Is that risk being driven by what's going on right now in the economy, or is it being driven on the potential outlook for policies that we could see ushered in by a Trump 2.0 administration?
I think it's both, right? I mean, the economy is in very good shape. That has nothing to do with the changeover come January. But there's some inflationary elements that continue to be sticky. You're seeing it on the services side. You're seeing it on the housing side. So some of the elements that were factored in getting that inflation target, getting us to that 2% inflation target, is a lot more sticky. So as a consequence, the markets are pricing that in, and then they're layering on the fact that immigration and tariffs and all these other factors, all else equal, are more inflationary than not.
How hard do you think it's going to be for Powell to speak with one voice today? I go back to this Nick Timiraos piece 2 days ago from the Wall Street Journal, and he said Powell faces misgivings from some colleagues over continuing to cut and less conviction from others who strongly backed those first two moves. How robust of a debate do you think this is actually going to be?
Well, I don't think anyone really knows. I mean, I think debate is good. I mean, there's so many open questions. To have just this kind of monolithic unilateral decision coming out of the Fed without debate, I think would be irresponsible. So I like the debate. There should be a debate. But I do think what's weighing on the Fed's mind is this inflation picture with the come of these policies that are additionally inflationary. So, I think we'll have a unified voice today. I think the rhetoric will be, much more kind of, less dovish, let's say, because I think they want to set the tone that they worry about inflation. And I do think the narrative has shifted from worry about the labor market to a slightly more concern around inflation.
Greg, not to outsource my job, but what's your one question for Fed Chair Jay Powell today?
The question is, what are those policies? How are you factoring that in? He'll never answer it, of course. But if you go back to the last time tariffs were on the table, they were more worried about the growth impact than they were the inflation impact, right? And so the markets are not thinking of it that way this time around. And I don't know if that's a mistake or not. So to come full circle, if these tariffs do come to fruition, I think the Fed might actually worry about the growth impact, which means more cuts than less than the inflation impact. And so that would be my question.
You're doing Mike McKee's job for him. Greg, appreciate it. Greg Peters there of Feature. Mike McKee, of course, will be in that news conference a little bit later. If you go back 12 months, do you remember this news conference 12 months ago when he implied they were thinking about reducing interest rates? And then the New York Fed President John Williams came out and said, we're not thinking about cutting interest rates. Then we went into January and we started to get CPI data through the first quarter of 2024, head fake. Then we went into the summer and started to get weak labor market data, head fake. We've gone back and forth, and this is why Rich Clarida, the former Fed vice chair, sat around this table at the last meeting and talked about a Fed chair that needed to find optionality going into 2025. And I think that's what he's got to carefully go about doing in this news conference later.
Does he care about the market response anymore? I remember when that was sort of a barometer of his success,
Sure.
And it seems to be not as relevant as it was, say, in January.
In the inflation years,
yes,
higher equity markets were a problem.
Right,
Do you
exactly.
remember that?
Yes, well, that's my point. And then people were saying it was a mistake.
Up next, UBS and a view from JP Morgan in just a moment.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
60 minutes away from the opening bell, equity futures on the S&P positive through most of this morning since we've been sat around this table. Equity futures up this morning by about 1/3 of 1%. On the Nasdaq 100 up by 0.2, clear outperformance on a Russell, a small caps. We'll see if that particular move sticks. We're up by 0.85%. going into the opening bell. With your morning movers, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. Take a look at this. This is the ADR for Nissan yesterday. Honda pursuing Nissan for a merger. It's certainly not going to be a merger of equals. I can tell you that for nothing. $8 billion is the market cap on this. $44 billion is the market cap on Honda. But this is about creating national championships. This is about political expediency, financial expediency. Senior advisors at Nissan say this: we're fighting for our life. We have 12 to 14 months to survive. So this is about a changing auto landscape on a global scale, whether it's how to survive in EV, survive against China, survive here in the EV market when those credits perhaps are shredded. Either way, this company has a maturity wall of $1.6 billion in 2025. This is as much about financial dependency on a deal as anything else. Let's see how it turns out. Honda's a little bit lower, down by 3%. National champions, it's not just China who builds those. Target. Now, John, you pointed this out. This was about an inventory landmine. I think when we did the results just a couple of weeks ago, the stock dropped by 20%. It was a catatonic day for the stock because they have not managed their inventory well. This morning, you've got Evercore going tactical, outperform, rising shopping intentions. I'm on the app at the moment. A positive inflection point in the web traffic. I'm part of that. Maybe not for Target, but for another brand. Let's have a look at General Mills. Häagen-Dazs, Lucky Charms, Nature Valley. I don't know anything about these three particular products. I haven't seen these products in a long time. Stock is down. They're lowering the guidance. They're saying it's an uncertain macro backdrop, higher investment levels. Yes, they're holding on to market share here in North America, but it is about price competition in that market, and it's about changing consumer habits and attitudes. I am the reformed in this particular sector.
What app are you on, Manus? What app are you on? Have they killed his mic? Okay, genius. All right, Manus, thank you.
It's got to be bougie.
Kill his mic because of the app he was on.
No, I'm just saying the app he's on is probably bougie.
Oh, right, okay. All right, maybe you can come back and tell us another time. Thank you, Manus Cranny. Thank you very much. If you go to the estimates for payrolls, you can look at the ranking on who is the best payrolls guesser, we can call him now, of the year so far. At number 2 is our next guest, Jonathan Pingle of UBS. So let's bring him in. Number 1. At number 1 is his son, Jonathan T. Pingle, over at Natixis. How cool is that?
I'm looking at this right now, and they don't even put Jonathan Pingle's name, the second one, because it's so confusing to have Jonathan Pingle as first and Jonathan Pingle as second. But that's quite awesome.
Ended up with Dad when we probably should have got his son, but this is the next best thing,
Thanksgiving
right?
must be amazing.
Yeah, just Jobs guesses.
Yes.
Yeah, we didn't anticipate this complication though when we named him.
Jonathan, it's good to see you. Keep it in the family. I think that's absolutely fantastic. Payrolls is behind us. We've had CPI. They were the two big data points going into this Federal Reserve meeting. Lots of people still expect them to cut interest rates, maybe set up a pause in January. Is that how you see things?
Yeah, no, I think that's exactly how we see things. I mean, not to be complete.
Is that how Jonathan T. Pingle sees things as well?
I don't know how he sees it. and not to sound completely uninteresting, but yeah, we're expecting a 25 basis point rate cut. I think Chair Powell, really previewed the language he's going to use already in his November 14th remarks in Dallas, where he's talking about, we're not in a hurry. We have the luxury of being able to, move more gradually. And I think that's basically all code for we're gonna skip January. A little bit like sort of Jim Bullard was saying. I mean, they got 90 days until the March meeting to figure out what they want to do next year.
So what are we actually going to learn? Let's say they go by 25 basis points today, as the market is currently pricing 95% chance of, and then they signal some sort of acceptance of a pause or going more gradually early next year. What could potentially get your attention that could adjust your expectations for the Fed in a different way than it currently is?
Well, I mean, we're expecting a number of small changes that I think are actually minorly big deals, if that makes any sense, to the longer run rate coming up, the terminal rate coming up. But I think the one thing that really could change things is how Chair Powell characterizes inflation. I've almost been surprised at how comfortable he has sounded with the incoming inflation data, both at the November press conference, at his remarks in Dallas 2 weeks after that, talking about we've got core X shelter in a range, shelter's going to make progress, really taking sort of the current stickiness in stride. And I think that, when I look ahead to next year and I think about the dot plot, are they continuing to cut, I think their current comfort with inflation is a big part of that. If he comes out and says something, different from that, like, oh my gosh, inflation might end the year at 2.9, we're really stuck here, I think that could really upend how I think of them proceeding in 2025.
Do you think that they should? Do you think that there is any evidence that that is the case?
Well, if I talk to our client base, there are a lot of people talking about how sticky inflation looks right now. The incoming administration, a lot of people think that these are things just directionally, less immigration, tariffs, more fiscal, is all directionally more inflationary when you've already got kind of stuck inflation, not far from 3%. When I look at the data details, it looks to me like they're finally making some progress on rents, and there's a lot of scope for improvement next year as you sort of lap the base effects. So I think they're going to continue to make progress on inflation and continue to cut next year. But I'm not sure that's actually the prevailing narrative amongst a lot of the marketplace.
Do you think there's a bias that Jay Powell has in terms of labor market or inflation? Does it keep shifting?
Well, I think it keeps shifting a lot, but I think it keeps shifting for kind of fair reasons, depending upon how concerned he is, right? They were obviously very concerned about the labor market in August and early September. The September employment report, I think, took out some of the downside risks in their minds. They're a little less concerned. But I still think he is fundamentally concerned about where the labor market is. At a headline level, it doesn't look bad, but it also doesn't really look great. The 6-month moving average of payrolls is 143, last 2 months is 132. Unemployment rates kind of drifted up to 4.25. Household survey details look kind of weak. That's all fine in a way, but I'm not sure they want it to weaken from here.
So if it does weaken from here, though, do you think that means the Fed isn't on pause at the next meeting, not today's, and we could see a cut in January as well?
I don't think they're going to cut in January because I would expect the December employment report to look okay. I think there's nothing indicating to me the economy is going to fall off a cliff between now and the January FOMC meeting. But I do think as they get into March and they consider their sort of gradual pace next year, I do think they're going to signal that they're continuing to normalize over time. And I think part of that is just because they don't want to see the labor market deteriorate much further.
If people aren't worried about runaway inflation, and they are worried about a deterioration in the labor market or the fact that a lot of people haven't caught up fully from the pre-pandemic, pre-inflationary surge, why wouldn't they mind actually running the economy a little bit hot and having inflation closer to 3%?
That's a fair argument. I've heard a lot of people say, look, workers need to make up some gains here. Let's try to run wages so that we can generate some real wage gains and sort of make up for the pandemic price increases. But they are also, on the other hand, I think a little bit worried about, when the inflationary mindset really becomes entrenched in consumers and businesses, that's just going to make it harder potentially for them to reestablish price stability after a period of high inflation. So I think when I think about Jay Powell and I look at the board and a lot of the committee, I do think there is a very kind kind of human element in how they think about policy. They don't want people, they don't want to hurt the labor market, people's incomes. But on the other hand, they do have an inflation mandate and a price stability mandate that they think they take pretty seriously.
Jonathan, appreciated this. Enjoy the holidays.
Thank you.
It's good to see you. Jonathan Pingle of UBS and the second best labour market economist in the family. Appreciate your time, as always. We're never going to let this drop now. That's amazing. Mike McKee's with us now, Bloomberg economic and policy correspondent. Mike, what are you looking for a little bit later?
Well, it's kind of funny. I'm going to come out and tell you that the Fed cut rates and nobody's really going to care. Everybody on Wall Street's going to go to the back of the book and see who done it. The question is, what do they do next? And I think the first thing we look at is the statement. It has a line in it about in considering additional reductions in the Fed funds rate, we will look at all these different factors. If they stick in the word any additional, that would signal perhaps a pause ahead. And then, of course, the dot plot. Everybody's going to be looking at the dot plot to see not just how many, but how often. And we'll see whether or not that, too, signals any kind of pause. That's going to be the main story for the markets today. You can see what it was last time. Markets think that they're going to go to maybe 2 or 3 from 4 next year. And we'll see if that holds and what kind of signal they want to sell to the markets today.
And Mike, do you remember the highlights last time? The headlines that came from the news conference. We don't assume, we don't speculate, we don't guess. And then a very abrupt, short conversation, which included the word no, I think, twice, and not in the law. Wasn't that it?
Yes, it's pretty great.
How different will it be this time around, Mike? That was the immediate aftermath of the election. What do you think the tone of this news conference will be?
Well, I'm not even sure that he'll get asked about his own, Jay Powell, we're talking about his own job now because people know his response. But I'm sure people will ask about the effect of Trump policies going forward, and they'll get the same answer, that we are looking at it, we're modeling various outcomes, but we can't really make policy because we don't know what those outcomes would be. Now, the one thing that might be included in their assumptions is that the tax cuts from 2017 continue. They are set to expire for individuals this year, but the belief is they're going to be renewed, and they are current policy. So if you're looking at current policy and what should happen, then they're going to incorporate that. But the tariff stuff, the deportation stuff, there's just no way they can put that into their forecast right now.
Mike, stay close. We'll come back to you in about 10 minutes' time. Looking forward to it. Michael McKee there. The last time we did this was the immediate aftermath of the election. Remember, it was the Thursday, it was pushed back because it was election week. And one of the pushbacks that you got to any question about changes in policy was that we have nothing to model. Well, we did have a couple of tweets, some posts on X, on Truth Social, about the threat of tariffs and the volume as well, the number that would be put on Mexico, on Canada, on China too. Do you think that's enough to start modeling some scenario analysis, start thinking about what that would mean for the economy, start speculating in a news conference like this one later?
It's certainly been enough for the market. And I guess that the key question might be, this is how the market is perceiving this. How much do you have to take that as fact? How much do you have to watch what the market is doing? And it kind of goes to the crux of this question. How much are they watching financial conditions and measuring financial conditions at a time where that used to be one of the key barometers and transmission mechanisms of monetary policy?
Priya Misra of JP Morgan joins us now, looking for a rate cut a little bit later on this afternoon, looking for 3 more through 2025. Priya, good morning. Good to see you. The 2-year yield has dropped at almost every single meeting this year, with the exception of one. It was back in September. Is this one going to be any different? Will this be another dovish, Chair Powell?
So, I think Chair Powell is going to keep all options open. He's not going to answer what's going to happen with policy. Frankly, he doesn't know. I'm sure they are speculating internally. I'm sure they're debating it. They've got all the scenarios out there. Is he going to tell us before we know the prioritization of the policy mix, the sequencing, the details? So I don't think we're going to hear much. He's going to try and keep options open. But let's look at, you asked about the market impact. We've priced in this hawkish cut. I think the market's done with this 25, assumes that this 25 happens. Yeah. We're all looking to 2025. And then the market's going to be looking at that dot plot. The market has 2 cuts priced, so 50 basis points of cuts priced in. If that dot plot, and I hate saying that the dot plot doesn't matter. it's not going to matter. What I'm watching is the reaction function. What do they do with the SEP in terms of the economic projections and the unemployment rate? What do they imply with the dots? Is the easing bias still valid? I mean, there's a lot of people who think that the Fed should be on pause, on hold after this. If they signal that the easing bias is still there, they want to be careful, continue to recalibrate, they can slow down that pace. That's the balance I'll be watching. If he suggests that they can slow down, but the easing bias is still there, I do think rates...
Let's go with that thing. So when you get the SEP, you get inflation, you get growth, unemployment, you get the dots, you get the longer run dot as well. What is it about how it's set up right now that implies there's an easing bias? And what kind of changes would you look for a little bit later that maybe says perhaps we've taken a bite out of that easing bias?
So I'll be watching what do they do with the inflation target for next year. If they move that up, or the inflation projection, if they move that inflation, they're then getting nervous that this, you know, you've had this hotter inflation prints in the last few months. The Fed actually has not addressed it. I actually think for good reason, because the things that were keeping inflation high, mostly shelter inflation, are lagging indicators. And in fact, the last CPI report suggested that it is coming down. So I don't think that the inflation number will be high, but if it is higher, and they move that long-run dot higher, they may be getting nervous that we're entering this policy fog, really, of next year with an already above-target inflation. The risk is that a lot of that policies end up being more inflationary, and then the Fed may have to pause, not because they think neutral is higher. I mean, we are talking so much about neutral. Neutral doesn't move that fast. But I think there's a structural aspect of neutral, but there's a cyclical aspect. If you have this policy mix that's inflationary, the Fed should be much slower in terms of that easing bias. So I'll be watching that inflation, unemployment rate. I mean, it's moving up. It's getting back close to 4.3. Is the Fed okay with 4.5 or 5? I don't think they are. I still think they don't want any further weakening in the labor market. So I'll be watching all those projections, and then what do they do with the dots?
Especially at a time when we don't really understand some pretty basic concepts of economics and how the Fed is looking at them. What causes inflation? What effect rates actually have on slowing or speeding up the economy? These sound like really basic things. This is the fundamentals. And yet that is at the heart of all of these questions, including whether they think these rates are actually really restrictive and whether they really are far from neutral. I'm curious how you see them judging what it means to be restrictive in markets that in many ways look like they are even having pockets of exuberance.
So great question. And I think it comes down to soft landings are rare. We don't have that many episodes that we can look at and say we're in a soft landing. Inflation's coming down for supply side factors. We've had a lot of supply side factors. You look at labor supply, you look at the increase in productivity. That's why the decline in inflation has been painless. But does that continue? And so we don't have too many historical metrics. I think they look at the totality of data. I would argue that monetary policy is restrictive for certain sectors, for certain aspects of corporates. If you need to borrow short-term right now, it is pretty restrictive. If you need to borrow, if you need to buy products from abroad, it is restrictive. So look at what's happened with interest rates, with the dollar. Financial conditions have tightened in the last few months. If you look at equities and credit spreads, they've eased. So we're looking at an economy that the Fed is a Fed for all people, or now that's, you know, but it has to look at the entirety of the economy. And so I think they will judge that it is restrictive for some and not others. But how much, right? The first 100 basis points was always going to be easy because we knew neutral was not 5.5. But is it 4? I think it's somewhere between 3 and 4. And as the Fed gets close to 4, I think then they have the ability to slow that pace down.
If the Fed comes out and sounds more hawkish than you're expecting or that the market's expecting, do you buy the long end of the yield curve?
I do, yes. I mean, not initially, and maybe not over the next week because we have a lot of auctions coming in. There's this concern around fiscal policy next year. But here's why I would buy. That means I think monetary policy is restrictive for certain parts. It becomes more restrictive. What happens to equities in that scenario? If they sound hawkish, I actually think the Santa rally that everyone's been waiting for, well, we haven't yet had it in the last 10 days, as you all have been talking about. You get a risk off, and then where do you hide? I don't think it's cash. I think it's bonds. Because if you look at the policy mix for next year, it's two-sided risks, very different from 2016, which was deficit finance, tax cuts, we need growth boost. This is an administration that's looking to rebalance, in my mind. They're not necessarily, let's throw more gas on the fire in terms of inflation. So I think you then start to think about where's value. Is it these very high equity valuations, or is it bonds? You're getting 5.5%, 6% stable cash flows from a corporate sector that's strong. That's what you buy, fixed income.
Priya Misra of JP Morgan. We'll end on that pitch for bonds into 2025.
Yeah, at a time when potentially, especially if the Fed is concerned about inflation, that actually will create a sort of a move away from equities into bonds. She also said this, and I thought this was really interesting. This administration wants to balance things. This isn't one that wants to throw gasoline on the fire. So as much as people are talking about this being pro-growth, expansionary spending, is that really the case?
Scott Bessent said that we're going through a Bretton Woods type of realignment, and I'd like to be a part of it. That was his pitch going into the Treasury.
We're going to see some shifts, that's for sure, in the next year. Priya, it's good to see you. Thank you. Thank you very much. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. The drone saga continues. The Pentagon denying it's involved in any of those mysterious drone sightings over New Jersey and across the Northeast. The Defense Department said none of the drones are being flown by the Pentagon or are part of any secret government tests. Instead, they say a vast majority are likely being used recreationally. President Joe Biden also commenting last night saying, quote, "We are following this closely. So far, no sense of danger." Meanwhile, Boeing is resuming full jet production in the Seattle area after shutting down for weeks due to a worker strike. According to the head of its commercial jet division, Boeing has now begun building the larger 767 and 777 aircraft again. The company cautioning getting production back to speed will take time because some workers need to be recertified and components may be out of position. And cocoa is soaring to new highs. Futures are trading above $12,000 a ton on supply fears amid mounting concerns over a weaker than expected crop in the Ivory Coast. Futures have almost tripled this year, up more than 180%, as poor harvests across West Africa contributed to the worst deficit ever and forced companies to draw down from stockpiles. That's Bloomberg Brief. John?
Hey, Yahara, thank you. Up next on the program, we'll set you up for the rest of the trading day as we count you down to Chairman Powell at 2 p.m. Eastern Time. That news conference starts 30 minutes later. Equity futures right now on the S&P, just coming off session highs. We're positive across the board. We're up 0.1%. From New York, this is Bloomberg.
The Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to
You know how sometimes when you're using a search engine, it can feel a little bit like, like you're just doing a bunch of work. Like you type in what you're looking for, and you get this huge list of links. And then it's like, okay, now we got to figure out which of these is actually going to be useful. Well, you send in some information.
Purple down the middle.
ChatGPT Search, which is this new project from OpenAI. And it seems like they're really trying to solve this problem. So this deep dive is going to be all about their new approach to using AI for search. And I got to say, I'm pretty excited to see where this goes. So the source material for this is a video presentation by OpenAI themselves. And right at the top, they made a pretty big announcement. They said that ChatGPT Search is now available globally and that it's free for everyone. So they had a bunch of other announcements in the video. But honestly, like the fact that this is going to be available openly really caught my attention.
Yeah, I think offering it for free is a pretty bold move. I mean, essentially, OpenAI is inviting everyone to just try out their new tech and to potentially like shake things up in a market that's, you know, dominated by some pretty established players.
Yeah, it's not just about being free though, right? I mean, the video really emphasizes that this isn't your typical keyword search. They're saying ChatGPT Search actually understands what you're asking. It can pull out relevant information directly from websites. And you can even have a conversation with it to like refine your search. So it's all about making search a lot more intuitive.
And conversational.
Right, and they illustrate that really well in the video with the example of searching for events happening in San Francisco. Instead of just getting a page full of links, ChatGPT Search presents these results visually with like images and descriptions, even a map. And then you can ask like, follow-up questions, just like you would in a regular conversation. Oh, and I love this one detail. ChatGPT search actually cites its sources. I mean, in a world where AI is sometimes seen as this, kind of like black box, having that level of transparency seems really important.
Yeah, it does. It goes back to, what we were saying before about the building trust with users. If you can see where the information is coming from, you're much more likely to feel confident in those results.
Exactly. And then they had another example where they were searching for restaurants in San Francisco, and ChatGPT search remembered their previous preferences, like wanting outdoor seating with heaters. So it's almost like it's learning your tastes as you go.
Yeah, that's the power of context. And it's something that traditional search engines have. They've really struggled with that. ChatGPT search is taking all these different factors into account. So it's creating this much more personalized experience.
And then there's the voice search integration.
Yeah.
Which, like, to me, feels super futuristic. You can actually talk to ChatGPT.
Naturally.
And it understands what you're asking.
I know. Imagine, like, you're walking down the street and you just say, "Hey, ChatGPT, find me a good coffee shop around here with wifey." And it just does it. It's like having this personal assistant, but one that's like plugged into the entire internet.
There was this really fun little moment in the demo where they asked ChatGPT to translate Merry Christmas into a bunch of different languages. And obviously, that's a pretty basic task. But it kind of shows the potential of what this technology can do.
Yeah, and it's interesting because while they're making all of this available for free, they are encouraging users to create accounts. And I think it makes sense from a business perspective, right? It's a way to access more features and avoid rate limits.
Yeah, it seems like they're saying, look, you could try all the basics for free, but if you really want to unlock the full power of what we're building, then creating an account is the way to go.
Exactly. It's like they're offering a taste of what's possible. And for a lot of people, that taste might be enough. But for the people who want to go deeper, there's this whole other level waiting to be explored.
So we've talked about some of the features of ChatGPT search. But what I'm really curious about is, like, what does this mean for us, like, as users, for the future of search?
Right. That's where it gets really interesting. I mean, think about how much we rely on search engines. They're like our gateway to information, our connection to the wider world. But for all of their usefulness, traditional search engines can sometimes feel a little bit impersonal, even a little frustrating at times.
Yeah, totally. You're constantly refining keywords, scrolling through pages and pages of results, hoping to find that one big nugget of information you're looking for.
But with this conversational approach, it feels more like you're collaborating with the search engine. Like you can ask follow-up questions, you can get clarifications, you can really explore a topic in depth. It's more engaging, it's more interactive, it's frankly more human.
I wonder if that shift in how we interact with information will change our behavior. Like, will we be more inclined to ask deeper questions, to explore different perspectives when search feels less like a chore and more like a conversation?
That's a fascinating question. I think it has the potential to, especially for like younger generations who are already so comfortable with voice assistants and chat interfaces. For them, this conversational approach might feel completely natural.
Yeah, it's like instead of just passively absorbing information, ChatGPT search encourages you to be more curious, more proactive in your learning.
Exactly. And when you think about it, that's how we learn best, right? Through dialogue, through asking questions. You're actively engaging with the information.
Okay, but let's get real for a second. How realistic is it to expect everyone to adopt this new way of searching? I mean, there are a lot of people who are perfectly happy with the way things are now.
That's true. Change doesn't happen overnight. But I do think there's a certain appeal to this approach. That could be pretty universal. It's about removing friction, making search feel less like a task and more like a natural extension of how we think and communicate.
And for people who might be
a
little hesitant to embrace the whole AI thing, is ChatGPT search difficult to use?
Not at all. That's the beauty of what OpenAI has done. They've made it incredibly user-friendly. If you can type a question or speed into your phone, you can use ChatGPT search.
So you don't need to be like a tech whiz to figure it out?
Nope. They've really designed it to be intuitive, even for people who are brand new to AI.
All this talk about AI taking over everything, though, does make you wonder if we're relying on this technology to do all the heavy lifting. When it comes to searching for information, what happens to our own critical thinking skills?
That's a valid concern, and it's one that we should be thinking about as AI becomes more integrated into our lives. But I don't think it's an either-or situation. I see it more as a collaboration.
You mean like instead of replacing our critical thinking skills, ChatGPT search could actually help us sharpen them?
Exactly. By providing us with more context, more perspectives, more information, it can give us more to think critically about.
I like that. It's not about letting the AI do all the thinking for us. It's about using it as a tool to enhance our own thinking.
Precisely. It's about working together to get a better understanding of the world around us.
So for someone who's just trying to find some quick information online, what's the big takeaway here?
Well, for starters, you now have access to a powerful new tool that can make your online life a lot easier. ChatGPT search can save you time, reduce frustration, and help you find exactly what you're looking for in a way that feels more natural and intuitive.
It's like having that friend who always has the answer, but without having to actually call them up and interrupt their day.
Exactly. It's like having access to this vast library of information, but one that can actually hold a conversation with you and help you make sense of it all.
I have to admit, I'm pretty impressed with what I'm hearing so far. But I'm also curious about the technology behind all of this. Like, how does ChatGPT search actually work?
Well, the magic behind the curtain is something called a large language model.
Okay, a large language model. Now, for someone who's not like knee-deep in AI research, what exactly does that mean?
So think of it like this. Imagine feeding a computer program a massive amount of text and code. Like, we're talking books, articles, websites, even like entire code repositories. A large language model learns from all of that data. It picks up patterns in language, grammar, even reasoning.
So it's kind of like teaching a kid to read, but on a few.
Ridiculously massive skill.
Yeah, that's a good analogy. But instead of just learning to read, this model learns to understand and even generate human language. So it can do things like write different creative text formats, translate languages, and most importantly for ChatGPT search, answer your questions in a comprehensive and informative way.
So when you ask ChatGPT, search a question, it's not just matching keywords anymore. It's actually like processing your request and like formulating a response based on all that data it's been trained on.
Exactly. And because these models are constantly learning and evolving, and getting
sophisticated.
better and more sophisticated all the time. That's what makes this technology so exciting. It's constantly
pushing boundaries of what's possible.
Okay, so I'm starting to get the picture. But I have to ask, is this just a fancy way of saying ChatGPT searches pulling information from, like Wikipedia or something? How does it know what's currently happening in the world?
That's where the real innovation comes in. ChatGPT search is connected to the internet in real time. So it's not just relying on some static data set. It's actually able to access and process the latest information from the web.
So it's like having this direct line to the collective knowledge of the internet, but one that can actually understand what you're asking. And give you a coherent answer.
That's a great way to put it. And because it's constantly learning, it's able to keep up with new developments, new trends, even new ways of speaking and thinking.
It all sounds pretty amazing. But where do we go from here? What's the next step for ChatGPT search, or even like AI search in general?
Well, that's the exciting part. We're really just at the beginning of this journey. As these models become more sophisticated and as computing power continues to increase, we can imagine search becoming even more personalized, even more intuitive. Imagine a search engine that anticipates your needs. It suggests relevant information before you even ask and learns your preferences over time.
Almost like mind extension, right? You're not just searching for information. You're interacting with a system that's helping you to think, to learn, to explore.
Exactly. And I think that's what makes this technology so compelling. It's not just about making search more efficient. It's about expanding our capacity for knowledge and understanding.
So for our listeners who are thinking, okay, I'm ready to give this a try, what's the best way to get started with ChatGPT search?
It's really easy. Just head over to chat.openai.com and create a free account. You can type in your questions, use voice search, even set it as your default search engine.
And I would encourage everyone to do so. I mean, we've covered a lot of ground in this deep dive, but the best way to really understand the potential of ChatGPT search is to experience it for yourself.
Yeah, play around with it. Ask it some tough questions. See what surprises you.
And that brings us to the end of our deep dive into ChatGPT search. We've explored its features, its potential, and even the technology that makes it all possible. But more than anything, I hope we've sparked your curiosity and given you a glimpse into what might be the future of how we find and interact with information. So until next time, keep exploring, keep asking questions, and keep diving deep. It's really looking strong right now.
Yeah.
But I'm looking at this analysis, and it's from Pound Sterling Live.
Okay.
And it's got me thinking, is the euro about to make a comeback? The analysis is called Tired of Buying Dollars, but Not Confident Enough to Buy Euros.
Okay.
So we're going to break this down, and we're going to see if the euro actually has a shot.
That's good.
Right. So the euro, it took a hit back in October, November.
Yeah, it did. It's been kind of stuck ever since then.
Stuck how? Sometimes I feel like these financial terms, they're just a whole other language.
Yeah.
Yeah.
No, I hear you. So think about it this way. If you were looking at a chart of the euro's value, instead of seeing this steep drop, it's been trading in a narrow range. So it's almost as if it's taking a breather before it decides, what its next move's going to be.
Okay.
That's what we call a sideways consolidation trend.
Okay.
But the key thing here, the key thing to look out for is whether it can break above that downward trend line.
So it's almost like it's got a hurdle to jump over.
Exactly. It's eyeing that hurdle.
Yeah.
And if it can clear it,
Yeah.
we might see a real rally.
So where is this hurdle? Where are we looking? What do we need to see?
Well, the article highlights 1.0628 as a critical level. So if the euro closes above that number on a daily basis, it could be a signal that the momentum is shifting. So think of it as a green light for potential upward movement. But even if that happens, it doesn't guarantee smooth sailing from there.
Okay. So it's not a guarantee, but it is something to watch.
Absolutely.
Okay. There's something else I want to talk about. The article also mentions the market seems tired of buying dollars, but is not yet confident enough to buy euros outright.
Right. Right.
So what does that actually mean for someone like me? I'm trying to make investment decisions. What does that actually mean?
Well, it's all about psychology.
Okay.
Remember the Trump trade.
Yeah.
That optimism after the election, the dollar was soaring. It's starting to fade. And the dollar's power is waning with U.S. interest rates staying low.
Okay.
But here's the catch. Investors are still pretty down on the Eurozone. So they're a little bit hesitant to fully embrace the euro, which suggests it might be undervalued.
Okay. Undervalued.
Yep.
That sounds like an opportunity.
Potentially.
But I do have one concern. The article also mentions there was some political drama in France.
Yeah.
There was that no confidence vote against the government. Did that impact the euro?
It caused a little bit of a stir.
How so?
So France issues bonds called OATs. Think of them as IOUs from the French government.
Okay.
When that political uncertainty spiked, investors got a little bit nervous.
Yeah.
And they started selling those OATs, which put some pressure on the euro.
So politics and economics, they're all kind of tied together.
Very much so.
But the article did say that selling stabilized.
Yes.
So are we in the clear?
It seems like for now, it seems like the markets are looking ahead to new elections in France in mid-2025. So the panic has subsided a bit.
That's good.
And here's something that might surprise you.
Okay.
Even with all of that drama, French bond yields are actually at their lowest point since early October.
Wow.
That's a sign of resilience that we shouldn't overlook.
So even amidst the political turmoil, it sounds like there's some glimmers of hope.
There are.
What else should we be paying attention to? What are the other factors at play here?
Well, this week, everyone's going to be watching the European Central Bank, the ECB. They have a big meeting coming up.
Okay.
And the question is, will they cut interest rates again?
I'm already on the edge of my seat. What are the chances of that happening?
It's a big question. The general consensus right now is that they'll cut rates by 0.25%.
Okay.
But some analysts are predicting a bolder move of 0.50%.
Wow.
Either way, cutting rates tends to weaken a currency.
Can you explain that?
Yeah. So think about it this way. Lower interest rates,
Okay.
they make it less attractive to hold that currency. So the demand drops and its value dips. This would likely push the euro down against the dollar, lowering the euro-USD exchange rate.
Okay. So if the ECB cuts rates, the euro could weaken.
It's a possibility.
But I remember the article mentioned some conflicting opinions.
Yes. There are some economists
Okay.
who believe that the ECB should hold off on cutting rates this time.
Interesting.
They argue that keeping some ammunition in reserve in case things get really bad could actually strengthen the euro in the long run.
Interesting. So it's about sending a message of confidence.
Exactly.
Okay. So even the experts don't really know what's going to happen.
It's a tough call.
What about over in the U.S.? What's going on over there that could impact all of this?
Well, the U.S. has its own set of factors to consider.
Okay.
We got a decent jobs report recently,
Okay.
but all eyes are on the upcoming inflation data.
Okay.
And that could really shake things up.
Why? Why is inflation data so important?
Because this particular inflation report is the last major piece of economic data that we'll get before the Federal Reserve makes its interest rate decision on December 18th.
So it's a big deal.
Very big deal.
Okay. So what are the scenarios? What should we be looking for?
So if inflation comes in higher than expected,
Yeah.
it might make the Fed think twice about cutting interest rates. Because remember, one of their main goals is to keep inflation under control.
Right.
And if they decide to hold off on a rate cut,
Yeah.
that could actually boost the dollar.
And if the dollar gets stronger, that would probably push the euro down.
Does he seesaw?
It is a lot to keep in mind.
Yeah.
This is complicated.
It's a balancing act.
It is. But that's the nature of the global economy, I guess.
Everything is connected.
So what does this mean for someone like me?
Well,
I'm trying to make sense of the markets and
Yeah.
make good decisions.
that's where things get really interesting.
Okay.
We'll dive into that in part 2.
Okay. Sounds good.
It means you got to stay informed and recognize that things can change quickly. There are definitely some potential upsides for the euro,
Yeah.
especially if the ECB makes good decisions and if that US inflation data comes in lower than expected.
Okay.
But on the flip side, things could go the other way
Okay.
and the euro could weaken further.
So no guarantees.
Right.
But sounds like there's potential.
Yes.
So we've got this wait and see situation with the euro, some hints that it might be undervalued.
Right.
We have the political drama in France. But thankfully, it sounds like that's starting to settle down.
It does. And remember that detail about French bond yields?
Yes.
Despite the political shakeup, they're actually at their lowest point since early October.
Right.
That suggests a level of resilience in the French economy.
Yeah. A lot of people might not know that.
Right.
It is fascinating how these little details can give us such valuable insights.
Absolutely.
And that's what I love about these deep dives.
Yeah.
We're not just skimming the surface.
Right.
We're really getting down into it.
Exactly.
Okay, so let's go back to that ECB meeting for a second. We've talked about them potentially cutting rates.
Yeah.
What are the arguments for and against that?
Good question. So the main argument for a rate cut is to try and stimulate economic growth.
Okay.
So when interest rates are lower, it becomes cheaper for businesses to borrow money and invest.
Okay.
And it also encourages consumers to spend more.
Okay. So it's like a little caffeine boost for the economy.
Exactly.
But wouldn't that also come with the trade-off of a weaker euro?
Well, that's the big question that the ECB is grappling with.
Yeah.
Some economists argued that a weaker euro can actually be beneficial in some situations.
How so?
Well, think about it. A weaker euro
Okay.
makes goods and services that are produced in the Eurozone cheaper
Yeah.
for buyers who are using other currencies.
Right.
This could be a major advantage for export-oriented industries.
So there are some potential upsides.
There are.
But I imagine there are some strong arguments against cutting rates as well.
Oh, absolutely. One of the biggest concerns is inflation. When a currency weakens, imported goods become more expensive.
Right.
And since the Eurozone imports a lot of goods, a weaker euro could push up inflation.
Yeah, that makes sense.
And remember, the ECB is tasked with keeping inflation in check.
Yeah. You got to walk that tightrope.
Exactly.
Okay. So what's your take? Do you think they should cut rates or hold off?
Well, I'm not in the business of making predictions.
Okay.
But I can tell you that the market is already pricing in a rate cut.
Okay.
So investors seem to believe it's a likely outcome. But as we've discussed, there are valid arguments against it.
Right.
So the ECB could surprise us.
It's a game of chess.
It is.
It really is.
They're constantly trying to anticipate each other's next move.
Okay. Well, speaking of global factors, let's talk more about the U.S.
Okay.
We touched on that upcoming inflation data
Yeah.
and how that could impact the Fed's interest rate decision. Can you walk us through that?
Sure. So the Fed is currently in wait-and-see mode.
Okay.
They're trying to get a sense of how the U.S. economy is doing. Before they decide whether to make any big moves, they've already cut rates twice this year.
Okay.
So the question now is, do they keep cutting or do they take a pause?
And that's where the inflation report comes in.
Exactly.
Right.
If those inflation numbers come in higher than expected,
Yeah.
it could be a signal that the economy is overheating.
Okay.
That might make the Fed reluctant to cut rates further.
Okay.
But if inflation stays tame,
Yeah.
that gives them more leeway to potentially cut rates again.
So it's a bit of a nail biter.
It is.
We'll just have to wait and see what those numbers look like.
We will.
But it sounds like whatever the Fed decides, it's going to have a global impact.
Absolutely. The US and the Eurozone are two of the biggest players in the global economy.
Yeah.
So their monetary policies are closely linked. If the Fed cuts rates, it could weaken the dollar,
Okay.
which could indirectly be good news for the euro.
Okay.
But if the Fed signals they're not planning to cut rates anytime soon, that could strengthen the dollar and potentially weaken the euro.
It's like they're dance partners.
It is.
They're always influencing each other's movements.
This very intricate dance.
Before we wrap up this part of the conversation, I want to explore one more angle.
Okay.
The political landscape.
Okay.
We've talked about France.
Yes.
What about the bigger picture?
Yes.
How might that impact the future of the euro?
That's a great question, and one that a lot of investors are thinking about right now.
Yeah.
Political stability, or the lack thereof,
Right.
can have a huge impact on how currencies perform.
Uncertainty makes people nervous,
It does.
and that can really shake things up.
Absolutely.
So, what are some of those political factors that we should be watching?
Well, elections are always a big one.
Yeah.
For instance, Germany is scheduled to hold elections in early 2025.
Okay.
And the outcome of that election could have major implications for the entire Eurozone.
How so?
Well, different parties have different economic and fiscal policies. So we could see changes in government spending or even shifts in the Eurozone's relationship with other countries.
Okay.
Any of these could boost or erode investor confidence in the euro.
So, elections can be a bit of a wild card.
They can.
What other political factors should we be watching?
Another one is the rise of populism and nationalism
Okay.
in some European countries. These movements often favor policies that can be seen as economically risky,
Yeah.
and that leads to uncertainty
Right.
and volatility in the markets.
Okay. So, are there any other political wild cards that we should be aware of?
Well, Brexit is still a factor.
It always comes back.
It does, even though the UK is no longer officially part of the EU.
Right.
The ongoing negotiations
Yeah.
and the trade deal between the UK and the EU could still have ripple effects on the Eurozone.
Okay.
Especially if there are disruptions to trade or financial flows.
It's a lot to keep track of.
It is.
So, we've got economic uncertainty, political risks, and these upcoming decisions from central banks. With all that in mind, what's your overall assessment of the euro?
Well,
Is it a good investment?
as you might expect, there's no easy answer.
Thank you.
There are definitely scenarios where the euro could gain strength, especially if the ECB manages things well and those political risks start to diminish.
Yeah.
But there are also things that could drag it down.
Okay.
Like a global economic slowdown or renewed political instability.
So it's a mixed bag.
It is.
Opportunities and risks.
Exactly.
I guess that's what makes investing so interesting.
It does. It's all about weighing the pros and cons, making smart decisions,
Right.
and hoping to come out on top in the end.
But investing is a marathon, not a sprint.
Exactly. It's important to stay focused on the long-term fundamentals and make decisions that align with your overall financial goals.
Okay. So don't get too caught up in those day-to-day fluctuations.
Exactly.
Now let's talk about the US dollar.
Okay.
We discussed how sentiment might be turning away from the dollar.
Yeah.
Do you think that trend is going to continue?
That's a great question.
Or is the dollar still king?
Well, the dollar has enjoyed a long run as the world's reserve currency.
It has.
It's benefited from a number of factors: the size and strength of the U.S. economy,
Yeah.
the relative stability of the political system,
Right.
and the depth and liquidity of its financial markets.
So are there any challengers to the throne?
There have been some whispers of discontent in recent years,
Really?
especially from countries that feel like the dollar's dominance gives the U.S. an unfair advantage.
Mm-hmm.
Some have even proposed alternative reserve currencies
Wow.
or systems that would reduce reliance on the dollar.
So there's a potential power shift brewing.
It's possible.
What could drive that?
Well, one factor to consider is the rise of those emerging market economies,
Okay.
particularly China and India.
Right.
As those economies continue to grow
Yeah.
and become more integrated into the global financial system,
Yeah.
they're going to want more influence.
Right. The more economic power you have,
Yeah.
the more say you want in how things are run.
Yeah.
Okay. What else could shake things up?
Another thing to watch is the increasing adoption of cryptocurrencies and other digital assets. Now, while it's still early days for crypto, it has the potential to disrupt traditional financial systems and create new ways for making international payments and investments.
So crypto is kind of a wild card.
It is.
It could be huge, or it could just fizzle out.
We'll have to wait and see.
It's hard to say.
It is. The world of finance is constantly changing.
It is?
It's important to stay flexible.
Right.
But no matter what happens with crypto or the dollar's dominance, one thing remains constant.
What's that?
Diversification.
Diversification, that's the golden rule.
It is. By spreading your investments across different asset classes, currencies, geographic regions, you can manage your risk more effectively and potentially improve your returns.
So even if the dollar loses its top spot, it's still smart to have some exposure.
Yes. But we should also be exploring other currencies and opportunities.
Right. To hedge our bets.
Exactly. We live in an increasingly interconnected world.
We do.
And having a global perspective is essential for investing.
This has been an incredibly insightful conversation.
So great.
We've learned so much.
We have.
From the euro's prospects to the bigger trends shaping the global economy.
It's a lot to take in.
More. So what are some of the key takeaways that our listeners should remember?
Well, I think the most important takeaway is that uncertainty is the new normal.
Okay.
Things can change very quickly, so stay adaptable.
Be ready for anything.
Exactly.
Any other pearls of wisdom.
Yes. I can't emphasize enough the importance of critical thinking.
Yeah.
Don't just follow the headlines or get caught up in the herd mentality.
Right.
Do your own research. Seek out different perspectives.
Yeah.
And ultimately, make decisions that align with your financial goals.
And your own risk tolerance.
Yeah.
Critical thinking. It's the superpower we all need.
It is.
So before we wrap up, I want to thank you so much for sharing your insights with us today.
It's been my pleasure.
It's always a pleasure to have you on.
Likewise.
And thank you to all of our listeners for joining us on this journey.
Yes.
Thank you. We'll be back next week with another deep dive into the world of money markets and the forces that shape our financial futures.
Looking forward to it.
That was a lot of information.
It was. We covered a lot of ground.
We did. I feel like we traveled the world.
We kind of did.
Okay, so let's get back to that title from the article. We were talking about tired of buying dollars, but not confident enough to buy euros.
Right.
We've talked about all these different factors that are influencing these currencies. But do you think now is the time to reconsider that dollar-heavy strategy?
Well, that's the million-dollar question, isn't it?
It is.
And there's no easy answer. Unfortunately.
Okay.
It really depends on your personal circumstances, you know, your risk tolerance.
Right.
Your long-term goals. A lot of different factors.
So it's not a simple yes or no.
It's not.
What are some of the questions that someone should ask themselves when they're trying to make this decision?
I would start by encouraging everyone to take a look at their overall investment strategy.
Okay.
You know? Does it still align with your goals? Has anything changed in your life that might warrant some adjustments?
Right. It's easy to set it and forget it.
It is.
What else?
I'd also suggest taking stock of your current currency exposure.
Okay.
How much of your portfolio is actually in US dollars? And are you comfortable with that level of exposure?
Right. It goes back to diversification.
Exactly. Don't put all your eggs in one basket.
Even if it seems like the safest basket.
Right.
So if someone is considering diversifying into other currencies, is the euro a good option?
The euro might be worth a look.
Okay.
As we've discussed, it's definitely facing some challenges.
Right.
But it also has the potential to appreciate in value.
Okay.
Especially if the ECB handles things well.
Right.
And some of those political risks start to fade.
So it's a bit of a calculated risk.
It is.
Yeah.
But with potential for reward.
Okay. Any final words of advice for our listeners who are trying to figure this all out?
Don't rush into any decisions.
Okay.
Take your time. Do your research.
Yeah.
And don't hesitate to talk to a financial advisor.
Good advice.
If you need help, you know, making those decisions.
Right, because sometimes that fear of missing out, FOMO,
yes,
can really drive some bad decisions.
It can. You want to make sure that you're making choices that are right for you.
For your circumstances.
For you, exactly. And remember, the financial world, it's always changing.
It is.
So what might seem like a good idea today could be a totally different story tomorrow.
Right. So stay informed.
Yes.
Stay adaptable.
Absolutely.
Never stop learning.
Couldn't have said it better myself.
This has been a great conversation.
It has.
I feel like we've learned so much
Me too.
about the euro,
Yeah.
the dollar.
Yeah, the whole global economy.
It's fascinating.
It is.
So to our listeners out there, thank you so much for joining us today.
Yes. Thank you for listening.
We hope you enjoyed this deep dive. And we'll be back next week with another one.
Looking forward to it.
So
I will
then,
show you how to
stay
get the
curious.
best funding for your
Stay
startup idea.
Keep on diving.
Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
A term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading on this Fed Day, the final Fed Day of the year. Welcome to Bloomberg Open Interest. I'm Katie Greifeld. You can see that markets aren't exactly celebrating the final Fed Day of 2024. A lot of questions, not about what they're going to do this afternoon. We know that they're going to cut rates, but what they do in 2025, that is an open question, and that is what investors are asking themselves heading into 2 p.m. and then Powell's big performance coming up at 2:30. But in the meantime, of course, the bells are ringing. The market is opening. You can see down at the New York Stock Exchange, Brazil Potash is ringing the bell. Over on the NASDAQ market site, Ocean First Financial. Let's take a look at these indexes. Just about 18 seconds into the trade, you can see a pretty quiet start. The S&P 500 just about unchanged, maybe to the red. We are just about flat on this week. We'll see how the dynamic changes, of course, after 2 p.m. You take a look at the NASDAQ 100. We were higher pre-market. Not the case anymore. Big tech index down a little bit. And then the Russell 2000, the small caps holding in there. We'll, of course, see how that changes when we get Powell's maybe thoughts, maybe predictions on how next year is going to go when it comes to the rate cut trajectory. But in any case, the Russell 2000 up about 0.5%. Let's get specific here, though, and let's talk about NVIDIA. It's rebounding a little bit from its October lows this morning. Remember, the stock entered into correctionary this week as investors broaden out AI bets from the Magnificent Seven. We were just talking about Micron, of course, reporting after the bell.
Yeah, let's talk a little bit about that because it is moving as well, getting specific in that AI trade. Micron up about 1.6% as the market opens. Shares are up 27% this year, and the street expects this quarter to be the strongest quarter of earnings expansion in years. Finally, we're also watching General Mills because it is still earnings season and it has turned lower after tweaking its full-year sales forecast to the lower end of guidance. points. Adjusted earnings per share did beat estimates in the prior quarter, but you're still seeing General Mills down 4.4% as the market opens. We're going to get a closer look at General Mills with Bloomberg's Abigail Doolittle.
Yeah, and here's this guidance that you were just talking about, Chanel. You can see that it had been positive for year after year, and now for the estimated 2025, we're looking at the possibility of a low single-digit growth decline for earnings. So, you know, in the context of the quarter, that was a beat. One analyst saying that has to do with the timing of Thanksgiving. Now we're seeing the other side of that, and the new targeting at the lower end of the old range, and we now have the new range, has everything to do with price cuts. So investors not really liking this all that much. We can see, though, it's not coming as that much of a surprise, despite the fact that the quarter that was good. If we take a look at the stock from September, we are going to see a pretty healthy decline here of about 16% today, a dip on the year, now slightly lower. Let's put this stock, this consumer stock, into the context of some of the other food stocks, and we're going to see that it's pretty much chugging along with the other ones, such as Conagra, Campbell's Soup. One that's clearly underperforming, Mondelez, and what makes this really interesting, Katie, is apparently, according to Jen Bartauschis, our BI analyst, the future is very, very bright for Mondelez. Especially the potential acquisition of Hershey and their interest in chocolate. But because of the record high cocoa prices, 2025 could come under some pressure.
Yeah, it's really interesting to see all those lines pretty much trending down over the past several months of 2024. Great roundup, as always. That is Abigail Doolittle. Meanwhile, let's broaden out this conversation and let's bring in State Street Head of Equity Research, Maria Waitman. Of course, it is Fed Day. It is maybe the last day that matters in 2024, and we'll get to the Fed, but I want to talk about basically this fizzling out that we've seen of all of these high conviction trades that came into being after the election. You think about the small caps, for example, you think about basically everything but tech catching a bid. It feels like that's fallen apart in the last several weeks, Maria, and I wonder what you make of it.
Yes, hello. I think the key drivers this year has been like kind of twofold. We had start of rate cutting cycles. That's your beta. That's why market's gone up. But relative trade has all been predicated on better earnings. And market is really reluctant to give the benefit of the doubt to companies or sectors or styles that don't have good earnings yet and expect it to do better. And I think small cap is really a kind of a poster child for that trade, where kind of current economic fundamentals are really challenging. Almost a quarter of companies are loss-making, margins are tiny, cost of funding is huge. So that's a difficult situation. Yes, potentially with more like growth-friendly environment, they might grow, but market wants to see profits now, and that's really hard to find outside tech. And hence kind of this kind of imbalance between the market. Tech does well, quality, large caps doing well. Everything that hasn't got growth yet is really struggling.
So do you follow that trade then? Do you just stick with tech and enjoy the momentum, or do you sort of swim against the tide here?
I mean, I have to say, I love tech, and I loved it for many, many years. I think the narrative around tech has changed a little bit. So we used to like it for beta, for cyclicality, for like low, for duration when interest rates were very low. Now, what we love tech for now is quality, size, low leverage, strong cash flows. So those things we love about tech, and it's really hard to find them anywhere else. So yes, we're sticking with tech trend, absolutely. I mean, we may be kind of changing the justification around it a little bit.
When you look at the 10-year drifting higher, now just around 4.4%, at what point does that drift higher make you think differently about the discount rates that you're seeing in tech? Is there anything that's completely immune to that move?
I think there is a little bit about beta for the market in terms of kind of overall higher interest rates. I mean, not great for the whole market, but I would probably argue they're a lot worse for kind of small caps or companies that really rely on, like highly levered companies that rely on this kind of cost of borrowing is like important part for them. For tech, I mean, arguably you can say they're actually making money on their enormous cash balances. So higher interest rates is not necessarily detrimental for them. So if you're thinking about kind of relative trade, then I think tech is a bit more immune than lots of other sectors, lots of cyclical sectors or smaller cap companies.
How do you position around tech at this point in time? The thing that Katie and I were talking about a little earlier is how much of the market is looking at some of those big run-ups you've seen, say, in NVIDIA, and start to look at other options when it comes to artificial intelligence. How do you make those choices at the end of the day? Do you like to stay in pure play AI and start to think about what might take a little longer to catch up to those valuations because you could buy it a little cheaper right now?
Well, I have to say, I mean, valuation is like a great concept in the long run, and we know that value kind of in theory should work by cheap. What we're seeing now is momentum trade. I mean, value has underperformed growth for like over a decade now, and I think what's really important and point like in a cycle when earnings are much more difficult to come by is to pay. As investors have to pay higher multiples for those stronger earnings, and that's really tech. That's really AI. So, I mean, we don't go down to stock level, but kind of sector-wise, it's still kind of broad-based tech trades that is dominating.
And Maria, given that it is Fed Day, I'm curious how you knit together, of course, the macro backdrop with perhaps some of the fiscal and some of the fundamental earnings that we were talking about. We were just having a conversation with Ron Temple at the top of the hour, who said that depending on what happens in Washington, the Fed might not be able to cut at all in 2025. What would that mean for this tech sector that, you feel pretty good about?
Yeah, I think it's really interesting dynamic. So for now, I mean, I feel for Fed and Chairman Powell. I mean, they don't know what kind of new administration policy would be. So for them, it's really hard to kind of design policy around the kind of unknown and uncertainty. And we've already seen some signs that all this really, really tough tariff talk is kind of a tool to achieve goals that like administration pursuing. So we really don't know. I think the very interesting tell would be what they do with their PCE estimate in the next year. So if they really increase their PCE forecast, that's probably a kind of a good tell that they think that whatever happens with new policy would be very inflationary, and they will have to react to it. If they don't, I think that would be a good sign that they feel fairly comfortable with the path of inflation and kind of the general glide lower in terms of policy rates.
What do you make of this argument that the neutral rate has been drifting higher? We were talking to Ron Temple over at Lazard a little earlier, and his estimation was closer to 3.5%. And if you believe that, then has the market adjusted to that reality? And how long will it take, if not?
That's a really difficult question, of course. I mean, neutral rate is something we know in hindsight, but I think market seem to be taking this in a good stride. We haven't seen really huge increase in break-even rates, so market is really not panicking. They feel like inflation is anchored. We have a really good estimation of kind of current online prices, so we kind of scrape prices of internet, see how online prices are changing. There is very little signs that there is any sign of panic, prices increasing and things like that. So for now, we see like inflation expectations really being fairly anchored, and kind of market feels to be quite relaxed about it. So I don't think we kind of focus on it too much. We need to focus on it too much yet.
State Street, Head of Equity Research, Maria Waitlist, thank you so very much for your time today. Of course, a big day with the Federal Reserve, and Katie, it's really interesting because you're looking at the S&P 500. The trade has been tough the last couple of days, but as our producer Dan Curtis points out, there's a breath reversal underway. What we said at the top of the show, you're starting to see it break down a little bit. Even though the S&P is down, 60% of the stocks are higher.
Yeah, I wonder how seriously, though, you can take any move on December 18th. Of course, it is the last day that matters. We do have the Fed this afternoon. We have some interesting earnings, but kind of in silly season.
Silly season, but we are getting off of kind of record low lack of breath here. So notable, nonetheless. Yeah. Anyways, we're paying attention. Now, coming up, more on the Fed as well as private markets. We're going to bring in for that Bruce Richards of Marathon Asset Management. You're going to want to stick with us for that. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy. And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It's time now for the Wall Street Beat. Bond traders are boosting wagers that the Fed is about to signal deeper interest rate cuts next year than the market anticipates. Wall Street is preparing for a potential rate pause in January. We're going to talk about those implications on private markets and public credit markets with Marathon Asset Management CEO Bruce Richards. You have still inflation above the Fed's target, yet the market is expecting another cut. What does that mean to you in terms of the trajectory of inflation going into a bigger easing cycle ahead, even if that easing cycle is less than initially expected?
Actually, a great question to open with. So 43 straight months, core CPI is above 3%. 43 straight months is rather remarkable. We haven't seen a stretch like this in a really long time. In the last 3 months, 3.3% is the number. And so the Fed, Powell won't tell us this, but they've given up on 2%. They've given up on 2 because they know the number's 3, and they know tariffs are coming, and so that's going to keep it firm. They know pro-economic policies are coming, less regulation, and so that's going to keep it firm. They know it's not going back down to 2. They can't tell us that. So what they're going to tell us in today's Fed meeting is they're cutting rates 25 basis points, and so from September 18th to December 18th today, exactly 3 months, they will have reduced rates 100 basis points. Probably a bit much, given growth is above 3% this quarter, GDP expected by the Fed, and given where inflation is. And so I think we'll see the dot plot go from 4 today, where it was previously, to 3. Next year you have 8 meetings. There's only going to be 2, maybe 3 cuts next year. And so most of the time they're going to be in pause, and that's going to keep the markets anxious next year because most of the times they won't be easing, and the markets really like to see an ease.
So what does this mean in terms of the trajectory of inflation next year? If you're a fixed income investor, inflation is killer. And so do you expect that it's going to be higher than anticipated? And do you fear, like some investors do, of a 70s style repeat?
I believe that the R-star, the real rate of rates is going to be higher the nominal rate's going to be higher. You know, the Fed has lowered rates after today 100 basis points, yet the 10-year note's gone up 75 basis points. And so the markets, the bond markets, aren't believing the Fed's language as it relates to inflation. They take what the Fed gives them in terms of the Fed easing. Equity markets love it. Debt markets love it. It's great for the economy, but real rates are higher.
Well, I think that's so interesting. You mentioned, of course, at 2 p.m. today, we'll have had 100 basis points of easing. The long end has just been, you know, it's been shocking to see that move. And, you know, you talk through the reasoning why it could be happening, but what does it mean for other asset classes? When does the equity market wake up to the fact that the long end is saying, hello, look at the trajectory of where things are going?
Well, the first thing it means is, and we haven't seen front rates come down 50 or 100 basis points and long rates go up by 50 to 100 basis points. We haven't seen this dynamic since 1990s. It's not happened since then. And what happened then was the economy was strong. That's why rates were going up. Yet the Fed was easing. And so what happened? Credit spreads went to their tightest levels ever. This is investment grade, triple Bs, double Bs, high yield, all to their tightest levels ever. So what we're gonna, and it stayed there for a year and a half.
Yeah.
So what we're gonna see, the first knock on, is the economy's doing well, earnings are doing well, and so corporate credit spreads are gonna tighten in, but yet you can earn a 7% in liquid markets in both, you know, high yield and other structured credit instruments that are non-investment grade. And so it's a good rate, but yet it's a really tight spread because the credit risk is being mitigated now.
Well, that's what's happening now, right? I mean, you have credit spreads across the spectrum at very, very tight levels, and you put it all together, you could make a case for backing up the truck on investment grade and on junk. Are you making that case?
Well, we've been buying and we'll continue to buy, and I think that you'll have a low volatility environment for those types of assets. And so, do you want to back up the truck now? I think you want to be equal weight now, but I think that within your kind of fixed income allocation, you want a nice, healthy allocation because I think the risk factor's down. The risk factor's being credit risk, and you're getting paid an average yield despite what's a tight spread.
So how do you invest through all of this at the end of the day? This is the setup. You believe that the rate is higher at the end of the day. You are seeing that divergence that you haven't seen since the 90s. What do you do with that?
Well, first of all, I think it starts, Sonali, with the 60-40 model, right? And the 60-40 model is alive and well, and it's how every investor, whether you're a wealth investor in high net worth or whether you're an institutional investor, should think about investing, the 60-40 model. And so within the 60, that's equities, and that's public equities, and that's how we think about it traditionally. But public equities have just had back-to-back years of 25% plus gains. You've only had that twice in the 90s and the 1950s. And so it's probably not going to be repeated next year because we brought forward, you know, some of this price action. And so I think this is the time where you want to say, okay, equities will make a 7% return, our historical return, and we'll really want to lean into private equity. And so think about public and private equity for the 60% model is how you want to think about that.
Bruce, we only have time for one more question left here, but you said this thing in the commercial break that I really want to get to. You told us you think Basel III Endgame is dead. You think that that has serious implications for credit markets. Your conversations with the banks right now, bring us inside of them and what that says about where the direction is going.
I do believe that Basel III Endgame is dead because I believe part of the regulations that we're going to see, the regulatory relief that we're going to see, is going to also transform into what's happening in the banking system. Rather than have these onerous rules placed yet on the banks, I think the conversations that Jamie Dimon and Donald Trump and other people in the administration, incoming administration, have with the bankers, will lead to that. And I know the Fed and Vice Chairman Barr has a lot to say about this, but I believe it's dead. And so what that means, it means the CET1 ratios of the banks, which are pretty strong and pretty large, it's going to unleash a lot of ability for the banks to be able to lend. The number one place they're going to lend to is they'll lend across the board, but they'll lend loan on loan. And so folks like Marathon will get really attractive financing from the banking system, and that attractive financing in the form of lower rates that we're going to be borrowing at will help drive our private credit returns. And so the 40 model, getting back to 60-40, is not only 40% fixed income, but half of that should be in private credit. Direct lending, we're seeing twice the deal flow that we're seeing today now, this past quarter, than we did in the whole last year. And asset-based lending is alive and well and taking off in a big way. And having that financing available from the banks is a big boon to all of us in the private credit markets.
All right, Bruce, come back in 2025, will you?
Definitely.
All right. Happy holidays when you get there. It's great to see you. We really covered a lot, so look forward to speaking again. That is Bruce Richards. He is the CEO of Marathon. And I said that it was the final day that matters, and I was half joking, half not, though. I get an email from Steve Sosnick over at Interactive Brokers. He says, no, it's Friday. We have that major NASDAQ 100 rebalance coinciding with the triple witching, so could expect some fireworks.
And you have the perfect guest to talk about it. You're bringing in Michael Saylor in the next hour as well. He knows a thing or two about that rebalancing.
That's true. Of course, MicroStrategy added to the NASDAQ 100. That will take effect on Monday. Really looking forward to that conversation coming up at 10:30. But coming up before then, Barclays getting bearish on oil. We'll have all the top calls next. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Barclays cutting its recommendation on the energy services sector, downgrading Halliburton to neutral, saying it's no longer a buy. The firm also says that global spending in oil services projected to be flat next year with downside risk ahead. Next up, we have Evercore ISI upgrading Dow to a buy. The analyst says that the company's prospects for 2025 are, quote, less bad, and he sees an attractive opportunity. Shares up about 1.1%. And finally, we have Baird cutting Rivian, saying it's no longer a buy. The firm cites a fast-changing geopolitical landscape. You can say that again. The analyst also says that Rivian has few catalysts in the new year. He also expects EV sales to languish. It has been a really interesting, a really volatile ride for Rivian and really a lot of its peers, including Tesla. Rivian down about 2.9%. Meanwhile, let's get a check on this stock market. Of course, we are awaiting the Fed coming up at 2 p.m. today. You have the trade that'll take place at 2 p.m. And then you have the reversal, of course, when Jerome Powell starts speaking at 2:30. But in any case, here's the setup heading in. You can see the S&P 500. It's pretty much flat on the day, which means it's flat on the week. It is green, though. You take a look at the NASDAQ 100, a little bit lower, a touch to the downside here, down about 0.1%. And then you have the Russell 2000, the little guys, your big leader, at least for right now, the Russell 2000 up about 0.4%. Now, coming up in the next hour, Michael Saylor joins the show to talk about MicroStrategy's Bitcoin buying and how he's preparing for 2025. Don't go anywhere. This is Bloomberg.
how do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Stacey Lynn. We begin with the investigation into the deadly school shooting in Madison, Wisconsin. CBS's Ian Lee reports.
The chief says their main priority right now is trying to find the motive. They say it's a combination of things. They're looking into social media, talking to people who knew her, also asking the public if they know anything to reach out and contact them.
An arrest in yesterday's killing of a Russian general. Through an interpreter, here's Svetlana Petrenko from the Russian Investigative Committee.
During interrogation, he explained that he was recruited by the Ukrainian Special Services. On their instructions, he arrived in Moscow and received a homemade explosive device.
To the conflict in the Middle East, where Israeli forces have pushed further into Syria. And according to officials, they're staying put. Correspondent Chris Livesay has more from Tel Aviv.
The defense minister said it's to deter rebels in Damascus, the same ones who just toppled Assad, who, quote, claim to portray a moderate facade, but are among some of the most extreme branches of Islamists.
All eyes on the Fed this afternoon, which will issue its final interest rate decision of the year. Business analyst Jill Schlesinger with what to expect.
Probably 1/4 percentage point, which is good, especially if you have a credit card debt or you're buying a car with an auto loan. Your rate should come down just a little bit. That's the expectation. We started the year 1 full percentage point higher, so this is good news for anyone who's looking to borrow.
It will be the third consecutive reduction of 2024, yet many experts are also bracing for a slower pace of cuts in the new year, with inflation still high. There's a new potential health hazard for mothers who breastfeed their babies. Here's CBS's Vicki Barker.
British researchers have found toxic PCBs and dioxin in the breast milk of mothers who live close to waste incinerators. They found those who had the highest or the longest exposure to particle pollution from the incinerator's chimneys had a higher level of these so-called forever chemicals in their breast milk.
Our Deborah Rodriguez on a new jaw-dropping discovery in New York.
It was a gigantic find in Scotchtown, New York. A pair of massive teeth poking up from the ground belonging to an adult male mastodon that roamed the earth millions of years ago. The State Museum says some digging by nearby university students uncovered a well-preserved jaw, a piece of the animal's toe, and a rib fragment.
Ahead of the expected Fed announcement on interest rates this afternoon, the Dow is up 158 points, NASDAQ down 12, S&P 500 up 2. This is CBS News.
Be available in all states.
The president-elect has picked an ex-football star to be ambassador to the Bahamas.
Herschel Walker dazzled on the football field in college and the pros.
Cuts to the inside. Herschel Walker. There he goes again.
But he lost a contentious bid for the U.S. Senate from Georgia 2 years ago that featured some gaffes.
And you know what's so funny? I am with many police officers.
Trump hailed Walker as someone who has spent decades serving as an ambassador for our nation's youth, our men and women in the military, and athletes at home and abroad. Steve Kathan, CBS News.
Madonna is teasing new music's coming in 2025. On Instagram, she's seen dancing in a video. The caption says, "Working on new music with Stuart Price. These past few months have been medicine for my soul." It's been 5 years since Madonna has released anything new. Stacey Lynn, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well, youtube.com. Search Bloomberg Podcast, and that's where you'll find us. Coming up, we got a merger in the auto business. A couple of big Japanese auto companies talking about getting together, Honda and Nissan. Being a former Honda owner, I am very interested in this. Steve Mann, he covers all the global autos for Bloomberg Intelligence. He's going to join us, break it down. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. He's got to explain Bitcoin, folks. We're back up to like 106,000. I have no idea what's driving that higher, but Mike McGlone does. Then around 10:30, we're going to have a simulcast with Bloomberg Television. Katie Greifeld and Shonali Basak are going to speak with Michael Saylor, MicroStrategy.
He is driving Bitcoin higher. Yeah,
you're exactly right.
See that correlation?
I like
Good job, Mark.
I like what you did there. That's exactly right. He's been buying it like crazy, so we'll see. Coming in our studios, Danielle DiMartino Booth, CEO and Chief Strategist at QI Research. Just one of the most informed voices, I think, on the Federal Reserve and Fed policy. She spent some time at the Dallas Fed, so she'll give us a preview of what we're going to hear from Fed Chairman Jay Powell today. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash. Lisa.
You got it in this Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers, lowest cost, global trading, turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. All right, we've got stocks. Well, just a lift higher right now. They have been mixed since the open. But right now, investors still waiting for the Fed's final policy decision of the year. The central bank expected to lower rates by 25 basis points. The focus on Chair Jay Powell's thoughts for January. Now, this morning, we had some more insight into the housing market. Housing starts fell 1.8% to an annualized rate of 1.29 million in November. That's a 4-month low. Building permits, those rose. So the NASDAQ, little change up about 4 points. The Dow up 132, 0.3%. The S&P 500, little changed up about 5. With the 2-year yield 4.22%, that's down 2 basis points. The yield on the 10-year 4.39%, and that is little change. To currencies, the Bloomberg Dollar Spot Index is little change. Cocoa futures hit another record in New York, climbing above 12,000. And let's get to those shares of Nissan because they jumped the most on record, closed up 23% in Japan. It's exploring a merger with Honda. Sources telling Bloomberg that deal could be expanded to include Mitsubishi, and that Foxconn approached Nissan about taking a stake. Now, Honda closed down about 3% in Japan. We had Foxconn up nearly 1%. And to add to it, Renault, Nissan's largest shareholder, said to be okay with this partner pursuing talks with Honda. Renault up about 6%. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. Just in case you didn't know, it's Fed Day. So that's happening. So we're all excited, 2 p.m. There are some individual stocks, though, and I find General Mills really interesting also and kind of what the read-through is on that. Because on the surface, it seemed like their individual sales were a little bit higher. It was the guidance that was a question. Billy Lipschultz is senior equities reporter for Bloomberg. What were the problems?
Well, the big issue, Alex, multiple, singular, multiple. The big issue is if you think back to 21 and 22, packaged food companies were hiking prices and then essentially bragging about it on earnings. Well, right now we're seeing General Mills, in order to combat consumers downgrading, they're actually cutting prices. So not only is that impacting their sales, they're finally driving prices lower. So that actually is going to impact their view for when you look at kind of obvious adjusted earnings. And when you're looking at the bottom line, when you're charging less for goods, you're going to actually take home less. And that's the big issue. And we're seeing this play out depending on if you look at dollar stocks or even just general retailers like the Macy's of the world. The big thing with consumer goods is that if you can buy Lucky Charms or you can buy the cheaper version for about 30% less at your local grocery store, consumers are increasingly downshifting. So to compete with that, they have to lower the prices.
Okay, so if they lower the prices, do they make up for it in sales? That's really the issue, right? Like promotion's okay if you can make up for it in scale.
As long as you sell more, but it's
Exactly.
still, it ultimately dents your actual profits, which is where it fell flat. You saw the quarterly sales were actually pretty strong, but when you look at net sales, again, net sales 2Q, organic net sales up 1%, estimate was for down 1%, but you're seeing the back end is where the issue is. So the last quarter was positive, but your forward-looking expectations is actually weaker than expected.
All right, Heiko, we're also looking at Heiko. What is that company again? Remind me.
They are in the aircraft parts space. Big, not big stake, but Berkshire Hathaway owns about 100 million shares of their Class A shares, so about $200 million bet for Berkshire Hathaway. This stock's down. Really the big issue is their electronic technology sales fell short of expectations. The big thing, though, to keep in mind, right now down 7.3%, so actually getting even worse.
Oh, wow.
Still up about 30% in the last 12 months. We've seen aircraft component makers. Loar went public earlier this year. We've seen GE's aerospace unit now trading quite well. It's been a hot area. So the big question is, what does the outlook look for? And we saw Jefferies analysts kind of calling out that the company chose not to provide their guidance. So that's really kind of the big issue. So they saw a decline in electronic. They saw a decline in defense products. So now are investors kind of rounding out positions going into year end? Are people just taking chips off the table from one of their winners? Kind of could be either or.
So I'm looking at kind of their customers using the supply chain function, SPLC. I mean, United, Delta, American, all those kinds of things. It kind of goes to the question, are people making more planes? Are they delivering more planes? I'm thinking Boeing, I'm thinking Airbus, and those types of things. Interesting. Okay.
Working in the new issue market, two of the companies that we saw go public this year, one is Standard Aero, Carlisle company that ripped on the IPO, now still only up 6% from October, but Loar, which is a much smaller company, ticker LOAR, is up 176%. Okay. And they're still in the same space, so a lot of maintenance costs and kind of keeping planes in the skies, especially given Boeing's uncertainty and issues around that company.
Right, which also then you have to make the point. I love their point about, just sell some winners, right? I mean, at the end of the day, into the new year. Okay, last up, Birkenstock. I confess I own 2 pairs of Birkenstocks.
What kind? Really?
Which I realize might not seem on brand for me, but they, yeah.
Are like the OG sandals? Like
but like one of them is like the magenta velvet, and then the other one is like super cute polka dot, But yeah, I know it's a little off.
Sweeney, do you have any? Do you own any?
Of course not.
Okay, I don't either. For the record. Stock up right now 6%, was up as much as 11% after earnings. Best day since earlier this year, beating expectations. But the interesting thing that stood out to me was they're targeting healthier margins, they're targeting more profitable products, which means they're trying to sell more of the clogs, men's dress shoes, boots, shifting away and expanding their offerings outside of the traditional kind of sandals, and also expanding into cheaper goods. So trying to get people to buy maybe a second, third, fourth pair when you're going on your Hawaiian vacation, and you don't want to bring your nice pair if you're getting in and out of the water. Buy a cheaper pair.
Exactly.
Helps them out.
He's speaking for a friend. I'm feeling that vibe. Actually, that's a great point. All right, thanks a lot, Bailey. Really appreciate it. Bailey Lipschultz joining us, Bloomberg Senior Equities Reporter. There's a ton of car news, so we wanted to dive into that a little bit more. We just had a headline that crossed that California gas car ban actually wins Biden's blessing, which really sets California up in a clash with President-elect Donald Trump. California has rules that require the sale of zero-emission vehicles and ultimately ban the sale of ICE cars by 2035. At the same time, we have a possible tie-up from Honda and Nissan, a tremendous earthquake that we heard really throughout the auto industry. Steve Mann is Bloomberg Intelligence Senior Autos Analyst. Hey, Steve, let's just start with the Nissan-Honda news. What's your biggest takeaway on this?
Well, I'm not too surprised that this is happening. You know, given the seismic shifts in the auto industry in the last 5 years, with these startups, Tesla, Rivian, Lucid coming on board here locally in the U.S. And globally, and then you have the 800-pound gorilla, the Chinese automakers, really growing fast, not just in their own markets, but globally. So, it's posing a lot of challenges to legacy automaker, and somebody like Nissan, which saw sales on a global level, drop as much as 50% over the past 5 to 6 years.
Wow.
They're going to have to do something to kind of pare costs down.
Would this be enough, Steve, for the combined company to compete on a global scale?
It's tough to say. I think initial thought is no. Because Nissan over the past few years have really cut back the number of models in the marketplace. They are overcapacitized. There's a lot of work that needs to be done. So I'm not sure if it really helps Honda in this type of merger. I think the tilt is towards it could be a drag to Honda.
Well, that was my question, is that I was reading that there might not be a ton of synergies in this, that it's just really all about scale. So can the scale be enough to offset that lack of synergy?
Well, I think that's it's going to be the ongoing trend, and every automaker and supplier as well will have to kind of revisit their long-term strategy, because you were saying earlier, California is actually moving away or moving towards all electric. Automakers and suppliers are continually facing increasing R&D expenditure as the propulsion investment diversifies away from gas and more towards other powertrain system. That's going to be really costly for the automakers, and the suppliers. So they're going to have to revisit how they're going to and make those investments going forward.
Steve, how much do the Japanese automakers have to compete against China? It just feels like it would be more than maybe the U.S. automakers do.
I think so, because if you look at the Japanese automakers, they're really prevalent in emerging markets. Toyota's all over the place, Honda and Nissan as well. They really, those cars, Japanese cars, were considered low cost. So they resonate with the emerging markets. And that's where the Chinese automakers are actually entering. The smaller markets in South America, Southeast Asia, Eastern Europe, really challenging head-to-head with the Japanese automakers, as well as the South Korean automakers.
Really good stuff. Steve, there's just so much to break down through all of this. We appreciate it. Steve Mann joining us, Senior Autos Reporter for Bloomberg Intelligence. I should say analyst, not reporter, my bad. And then there's the Foxconn thing, like Foxconn on's in. It's so confusing.
Well, the thing about Japan, which I learned early in my career, is there's just a lot of cross-investment between companies. Even if they're out of industry, just different. I think it's just, I can't remember the reason for it other than we're all in it together, and let's have close relationships between companies and management teams and that type of thing.
Whether or not it's successful, so it's not rare, but whether or not it's successful really is a case-by-case basis. All right, coming up, as promised, we'll be talking Bitcoin. First, you got Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist on Bitcoin as well as all commodities. And then we have Michael Saylor, MicroStrategy Chairman and co-founder. MicroStrategy is the place that's buying all the Bitcoin. So Michael Saylor is the guy who's moving Bitcoin. So we definitely want to get his conversation. Bloomberg TV anchors Katie Greifeld and Shonali Bassick will be joining us for that call.
All right, and starting at 4:30 Eastern Time, head over to Bloomberg.com for a Bloomberg Live Q&A. Our team of expert reporters will answer listener questions as they cover the Fed decision, market reaction, comments from the Fed Chairman Jay Powell, and the state of the economy for President-elect Donald Trump. That's 4:30 Wall Street time on Bloomberg.com.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks advancing as traders brace for the Fed's widely anticipated rate decision and its forecast for next year as well. We have the NASDAQ up 0.1%, 23 points at 20,132. The Dow up 0.3%, 150 points, 43,599. And the S&P 500 up 0.1%, 9.6,059. The two-year yield 4.22%. That's down 2 basis points. The yield on the 10-year 4.39%, and that is little changed. To commodities, we have Brent crude at $73 a barrel, WTI crude up more than 1% at $70 a barrel, and we have spot gold lower at $2,636 an ounce. The Bloomberg Dollar Spot Index right now is little change. Few stocks on the move. That's Lucky Charms maker General Mills. The shares down nearly 3%. The company scaled back its profit expectations, even though its most recent quarter beat forecasts. After the close, we move on to home builder Lennar and Micron Technology. We move over to ChargePoint. Their shares up nearly 6%. The company and General Motors, well, they plan to install hundreds of those ultra-fast electric vehicle charging ports across the nation. And we end with Birkenstock up nearly 7%. And that's thanks to a boom in those closed-toe sneakers, boots, clogs, and slippers. They're a little bit more expensive than those classic sandals. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, so thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. All right, let's get to Bitcoin here, trading at $104,000, briefly surpassing that 108 level before falling back. Want to get more with Mike McGlone. He is Bloomberg Intelligence Senior Commodity Strategist, and just shameless tease, in just about 6 minutes' time, we'll be talking to Michael Saylor, MicroStrategy chairman and co-founder, which basically is the deal, right? MicroStrategy is buying Bitcoin, full stop.
Well, there you go. Well, Michael Saylor, when he tilted towards Bitcoin in 2020, that really accelerated my bullishness. And that was around $10,000. And it's kind of when I started looking for $100,000. But we're there. And we've had probably one of the best years ever, I think, ever for Bitcoin, ending with the culmination of this Trump transmogrification from an antagonist to a zealot. And now it's just so bullishness. I have to admit, it's kind of the weakness of being a commodity person. I'm inherently contrarian. There's so much excessive bullishness in this space and speculation and fraud. I have to say, be careful. The one thing I like to point out, Alex, if you look at things like all the other altcoins, there's an unlimited supply of cryptos, millions and millions. And I'll end with this headline on Bloomberg Terminal made you realize there's something wrong. And it's just getting, not wrong, but expensive. The headline in the terminal the other day was, Bartcoin steals the spotlight from Dogecoin, Shiba Inu to reach 264 million all-time high market cap. It's just silly.
So what's the, as a commodities analyst, Mike, how does something look like it's gone too far too fast to you?
When everybody you speak to is bullish and they say silly things, and this is a key thing I remember in 2017, Paul. You hear and say, here's silly things that are very if statements that are very low probability as a bullish thing. The key thing that most crypto bros are focusing now is the potential for the U.S. to start a Bitcoin reserve. Like, oh boy, that's kind of silly. And most prudent people, including Larry Summers, even Nick Carter, who was on Bloomberg the other day, point out that's kind of silly to do that. But people are pointing out this fact. And it's just, it's the prices. You can look at prices extremes. And I like to use one example that's really been hitting the tape is you look at Dogecoin. It's basically a joke. Its market cap is about $60 billion. What's been hitting the social media, that's about the same as BNY Mellon. BNY Mellon has been around for 200 years. And by the way, it does have about $15 billion a year of revenues, and the other one is just it's going up because there's more buyers. So I think we're into that extreme speculation froth stage, and the prudent thing for most people who've been involved to do is consider profit taking.
But on the other hand, we could have made this argument 8 months ago, 3 years ago. So that's what I find to be quite confusing.
Yes, well, your yeah buts are great, but the difference is price. First of all, 100,000 is a major milestone. And then what happened this year? Remember, we had the U.S. ETFs launched. We had the halving, the record-setting stock market, Trump's tilt. So it's like, how much is it going to get better? You've seen it's just going to get it's about as good as it gets. The key thing I like to point out, even despite this, despite massive outflows in gold ETFs and inflows and Bitcoin ETFs, gold is still beating the S&P 500 this year. So I'm worried about, one key thing I've watched for about at least a decade is that Bitcoin to gold ratio. Right now it's about 40 ounces of gold per one Bitcoin. It's an all-time high, but it's really been lagging the record-setting stock market lately. And when I hear Gina Martin Adams getting a little bit bearish on stocks, Gina Martin Adams is our equity strategist, I like to point out the correlation between Bitcoin and this S&P 500 on 100 days is the highest ever on the way up. So it means this risk basket is everything's expensive. And I think we still have to see the key test. Just a little back and fill in the stock market potentially as Trump kicks in with his tariffs would be a key test. And I think Bitcoin's more acted as a leading indicator with a high volatility and go down.
All right, there you go. Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, phoning it in from the self-proclaimed crypto capital of the world, Miami, Florida. I wonder if that's actually a thing. But,
Miami, Florida? So
yeah.
they tell us.
Yeah, exactly. So, but interesting. I just kind of view, and this is from Mike's research, I just kind of view Bitcoin as a commodity, and you just have to have a call on supply and demand. I think we know the supply end of the story, which is it's not growing that much, and presumably, if you think there's more use cases for crypto broadly defined, it goes up, I guess.
What I find really interesting is the reasons why people buy it, now that it's become so much easier to buy it, the why behind it. So are you buying it as a safe haven and diversifier to help protect against volatility in other assets? And at the same time, the guy next to you could be buying it for risk on animal spirits.
Yes.
Is that normal in certain asset classes?
I don't think, I compare it to gold. I compare it to gold.
It's not like that for gold.
I mean, I think some people buy it as a hedge against inflation.
Yep.
And I think some people buy it on a speculative basis. They just think it's going up for whatever reason.
Which is really quite interesting because I don't know another quote unquote safe haven that might behave like that unless you look at like Mag 7s as being a safe haven and a growthy area, but that's a kind of tricky thing to think about. But you can't argue with the fact that it's gotten a lot easier to buy it, so you have more mainstream ETFs, and there's some diversification that you can as well. So that brings in just different managers all across the board.
And it brings in some other buyers as well. You've got Elon Musk buying it for the balance sheet of Tesla, and you've got some other corporate folks out there buying this, as I understand it.
So now we're going to get to the good stuff.
Yeah.
So Michael Saylor is MicroStrategy chairman and co-founder. He's up in just a moment talking to Sonali Basak and Katie Greifeld. They're Bloomberg TV anchors. We're going to bring you that in just a moment. So you have Bitcoin trading a little bit heavier. I mean, all relative, $104,000 per Bitcoin. The value just exploding ever since President Trump was elected. So we have lots to talk to Michael Saylor about. Let's go right now to Bloomberg Television. Katie Greifeld, Sonali Basak with Michael Saylor, MicroStrategy chairman and co-founder.
We welcome now our Bloomberg TV and radio audiences. And MicroStrategy still buying Bitcoin amid the token's record run. It's bought the digital currency for 6 straight weeks, bringing its total haul to $45 billion. And that's all before MicroStrategy joins the NASDAQ 100 index next week. Now, the company's share price is outperforming Bitcoin itself this year as retail traders and hedge funds pile in and capitalize on the volatility. I'm pleased to say that we're joined now by MicroStrategy co-founder and executive chairman Michael Saylor. And of course, we're going to get to the Bitcoin purchases, but I actually want to start with the politics of it all, because you've been relatively less vocal than some of your peers in the crypto community about your political views. And I have to ask, have you met with President-elect Donald Trump?
I've met with a lot of people in the incoming administration, but I couldn't comment further than that.
Okay, can't comment further than that. I was going to ask you about plans, but instead I'll ask you about whether or not you would be willing to serve in the Trump administration in any capacity. Bloomberg has reported that there potentially could be a crypto advisory council. Is that something that you might be interested in?
You know, I'm always willing to provide, thoughts on constructive digital assets policy, either in confidence or publicly. And if I'm asked to serve on some sort of digital assets advisory council, I probably would do so, yes.
Michael, I also want to talk to you about MicroStrategy, your own plans. It's amazing. You have announced plans to raise $42 billion over 3 years. You announced that back in October. But the rate you're going at, and this is through convertible debt offerings, stock sales, the rate you're going at, you could fulfill that target by January. Are you planning to lift that cap and line up more facilities in the pursuit of more Bitcoin?
Yeah, when we announced it, it wasn't clear how enthusiastic the capital markets would be, but we got a very enthusiastic reception. And then after November 5th with the red wave, we saw a big sea change in the political environment. And so we went faster than we had thought we were going to go on October 30th. Our goal is to continue to raise capital primarily through fixed income markets. So we'll pursue preferred stock or convertible bond or other equity-linked financings, as long as it's created for our shareholders. When we get through the 21 plan, which is $42 billion in capital, we'll revisit our capital plan, and we'll put in place a new plan subject to market conditions at the time.
All right, so we'll look forward to that. I am curious, with what you've raised so far, it seems like you've been tapping the market facility more so than converts in order to raise cash. And I'm wondering if there's anything to read into that.
Well, just the equity capital markets were very enthusiastic over the past 4 weeks. And so we're always considering, is it the convertible market? Is it the fixed income market? Is it the equity market we want to go to? And that's going to change from time to time. I expect that mix will shift more heavily toward fixed income markets in Q1 as we go forward, because right now we're probably getting a little bit too delevered, and we'd like to actually get more leverage. We have about $7.2 billion of converts, but $4 billion of them are already essentially equity. They're through the strike price, they're through the call price, and they're trading with a delta approximately 100%. So they're looking like equity. And so we would like to go back and build more intelligent leverage for the benefit of our common stock shareholders.
Yeah, speaking of common stock, of course, one of the big pieces of news, as Katie has talked about, was your index inclusion in the NASDAQ 100. And one big question is, would you or are you selling newly issued stock to index trackers? Is equity something that you'd be looking to add to instead?
When we execute the ATM, we just sell equity into the market if we like the price and we like the terms. And if we think that the equity is undervalued, we don't. But we don't specify any particular buyer. I think that's just pari passu to every other investor in the market.
So I want to get a little bit philosophical because, we're talking now about NASDAQ 100 inclusion, and you're joining, of course, because MicroStrategy is nominally a software company. You founded it in 1989 as a software company. Do you still consider MicroStrategy a software company?
Well, we have a very healthy software division now, and we're very proud of it, and I did create it. But we think of ourselves primarily as a Bitcoin treasury company now. So our primary method of generating shareholder value is through our treasury operations. And if you think about, there's 3 ways to create value for the shareholders. There's operating income, and our software business generates about $75 million a year of operating income. There's also investment income. That's been difficult to track, but right now we have $18.6 billion of unrealized investment income. People will start to get a better handle on that when we switch to fair value accounting next year, and then you'll actually see investment income captured in GAAP accounting. And then the third way to create shareholder value is acquisition income. So when Apple buys back its own stock, or when Oracle does M&A acquisitions, or when you do an LBO, you're basically taking capital, which is cheap, to buy a capital asset, which is a higher return. So MicroStrategy is engaged in that capital acquisition process. We issue equity and debt. We buy Bitcoin. That's resulted in about a $14.4 billion benefit if you value the Bitcoin at 105 for our shareholders this year. And so we do all 3 of those. Obviously, the big numbers, the investment income, the acquisition income are more due to Bitcoin treasury operations.
Well, I'm glad you brought up the accounting rules in particular for this reason, because obviously NASDAQ 100, wondering now, with the rules around profitability for the S&P 500 inclusion, does that accounting rule get you to the place where you think that the S&P 500 comes next for you? And how soon do you think you can get there?
Obviously, it's the decision to enter the S&P 500 is above my pay grade. So they will make that decision. But I'm optimistic in 2025 when we adopt fair value accounting, when we end up with $50 billion of assets on our balance sheet under fair value, if Bitcoin goes up 20% a year, you're looking at $10 billion a year of investment income. So I expect we'll be generating billions of dollars a year or tens of billions of dollars a year of investment income, which becomes GAAP profitability. And I think that is the final thing people are looking for inclusion in the S&P.
And that would certainly be a sign of the times if you did get included in the S&P 500. So we'll have to keep in touch on that one. But I want to go back to the Bitcoin buying, and I want to talk about how you actually purchase the Bitcoin. Are you buying through an exchange, over the counter, peer-to-peer? This, of course, is made more interesting by the fact that obviously you're buying in bulk.
We use regulated exchanges in the United States like Coinbase. And when we're buying, we'll be buying, you know, on a simple like TWAP algorithm. So our goal is to not be noticed by the market, not to move the market. If anything happens with the Bitcoin price or even with the MicroStrategy price, it isn't us. Our objective is to basically be market participants, but never move it up or down or be noticed.
You know, it's interesting. I want to go back to something Katie was talking about before in definitions here. Are you a software company or not? But when you think about the legacy software business at MicroStrategy, what role does it have? Would you consider spinning it off?
No, we're very partial to it. We love the software business. I invented a large piece of it. We love our customers. We enjoy it. It's profitable, and it's a core part of the company's identity.
All right, well, worth asking anyway. I am curious about, you know, this unique treasury model that you have. Obviously, you've had great success at MicroStrategy with having a Bitcoin treasury. You recently pitched Microsoft, though, on investing in Bitcoin. That was rejected. But are you surprised that you haven't seen more traditional companies follow your lead here and invest in Bitcoin?
I think Microsoft's one of the great companies in the world, so they don't really have a need to adopt a new idea. But in essence, Microsoft's strategies are to buy their own stock back and to park short-term cash in treasuries and then to pay out dividends. That's very conventional. That's the finance playbook that would be taught at Harvard Business School. And if you're a successful company with a great business, you tend to stick with that playbook. The playbook changed, really it changed a few days ago when fair value accounting became mandatory. You know, when we go into 2025, I think you'll see the repeal of SAB 121. I think you'll see fair value accounting. I think you'll see Bitcoin embraced as a digital commodity by the regulators. We already can see the political winds are very favorably shifted. Now, for the first time in 100 years, large public companies have a capital asset that they can consider in lieu of treasury bills, and that's Bitcoin. It doesn't make sense to consider real estate or gold or paintings or barrels of oil as a treasury asset. It does make sense to consider Bitcoin. So really, we're year one of a new era, and I would think that the companies that embrace it first are the ones that have a need to know, or they're very close to the Bitcoin industry, the digital assets industry. The Magnificent Seven, they'll embrace it later because they don't need it now.
All right, Michael, that's a good place to leave it. Always great to speak with you. That, of course, is Michael Saylor. He is MicroStrategy chairman and co-founder.
All right, fascinating discussion there. Michael Saylor, MicroStrategy chairman and co-founder, speaking with Bloomberg Television's anchors Katie Greifeld and Shonali Basak. Again, Bitcoin, they're buying it left and right. Bitcoin's down 1.8% today, $104,500 per token. How about that? All right, let's get a reset of these markets here. We can go do that with Lisa Mateo on a Bloomberg Business Flash.
And you got it. On this Fed Day, stocks advancing ahead of the announcement from policymakers, words from Chair Jay Powell. Our coverage begins at 1:30 Wall Street time. Be sure to tune in there. We have the NASDAQ right now up 0.2%, 43 points at 20,151. The Dow up 0.5%, 227 points, 43,678. And the S&P 500 up 0.2%, 15 points at 6,066. The 2-year yield, 4.22%, down 2 basis points. The yield on the 10-year, 4.39%, and that is little change. The Bloomberg Dollar Spot Index is little change. We have the Japanese yen is weaker, Euro British pound weaker. We have Bitcoin down nearly 2% at just over 104,000. Few stocks on the move. We'll start with Netgear, and if you're saying who? Well, it's the company that makes Wi-Fi routers. And after news from the Wall Street Journal that the U.S. is considering a ban on this popular Chinese-made router, Netgear stock is getting a boost. Its shares are up about 15%. Companies making news, that's Merck acquired the exclusive global license to develop, manufacture, commercialize obesity drugs from China's Hansoh Pharmaceutical Group. That deal is worth as much as $2 billion. UniCredit increased its holding in Commerce Bank to about 28%. And finally, Walmart headed for its best year since 1998. Its shares have surged 82%, adding more than $340 billion to its market value in 2024. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news that you need to know. We are live from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube. All right, it's Fed Day, so therefore we have the expert on to give her take on what's going to happen. Danielle DiMartino Booth, the CEO and Chief Strategist at QI Research, and she joins us now live. All right, so what are the key points that you're looking for?
So I'm going to be looking to see how measured Powell's comments are and how enthusiastic or not he is about the economy. I'm not so sure that we're going to see as much bravado as we've seen lately. The last time he was at the podium, what preceded the latest release of the quarterly census of employment and wages, which took down wage growth quite a bit. The last time we had a dot plot in September, Powell said the Fed is mentally adjusting payroll numbers based on QCEW. I'm reading a Bloomberg headline there. And now we know from the Philadelphia Fed, after they crunched through the numbers, disagrees with Anna Wong's analysis, actually, that payroll losses started in the second quarter of 2024. We're in the weeds here. This is kind of arcane stuff. However, if the Fed is going to be attentive to what the Cleveland Fed is presenting, they expect shelter inflation to decline from 5%. That process has already begun to 2% year over year by the end of 2025. If you pile on the fact that it looks like payroll losses began in the second quarter of 2024, these are elements that are going to have been incorporated into many, many presentations around that big oval table in the Eccles building. These aren't things that they can ignore. And economists, lifelong economists, they're used to having to look into the rearview mirror. It was 5 quarters before we knew that the first quarter of 2001 or the first quarter of 2008 were actually negative GDP prints. The GDP is the last to reflect these. But if we know we're losing jobs as of April of 2024, the Fed's talking about it.
So that would suggest to me, from your commentary, that you would think the Fed would be cutting into 2025, because I think the market's been moving away from that a little bit.
The market has been moving away. Bond traders have been moving in the opposite direction, as Bloomberg's been reporting here over the last 24 hours or so. And I think that I think Powell is going to really lean on we are data dependent, even with the positive revisions that we saw come out of the latest non-farm payroll report. We still had private job losses in the month of October, despite the comeback that we saw after the Boeing strike. Of course, those Boeing workers are all being let go. In the first quarter, we're seeing the same thing from Stellantis and a lot of bloodletting in coming out of the manufacturing sector. That really has yet to let up. We saw backlogs in S&P Global Manufacturing Indices really fall to their lowest level, and backlogs they're a gauge of future demand. That means that there's going to be more layoffs in the coming year. The industrial recession is definitely starting to bleed into the services economy. We saw that with yesterday morning's New York services survey.
I thought the services were really good. What am I missing?
The headline S&P Global Services was good, but if you look again, I refer back to the QCEW. What S&P Global does not include in their services, which is what ISM does, is construction, retail, mining, and wholesale sales. So once you cut those 4 critical cyclical sectors out, you understand that you really are looking at apples and oranges when you compare S&P Global Services to the United States, to what ISM is, which is a much more holistic read, and it's been appreciably weaker, especially on that employment side. But again, where have we seen weakness in services? That would be construction, that would be retail.
Dot plots. We get some dots
Dot
today.
plots.
DOTS Go for Bloomberg terminal users out there. You can see where the dot plots, the dots are actually plotting out over the next several periods. What should we look for there?
Well, I'll be looking for whether or not we're going to stay at an anticipated potential for rate cuts in 2025. Of course, the question is going to be: are those going to be front loaded, or are they going to be trickled out across the year, one per every meeting with the summary of economic projections, or will we see something possibly by January 29th?
What I'm trying to understand is what would be a good result for the market. So and how do we categorize that? So what decision today or what dot plot gives us, I don't know, a higher equity market, gives us lower yields? If we call that a win?
I don't know that we necessarily call it a win if we walk away after Powell's presser this afternoon and say maybe they are going to be lowering rates at the end of January. I don't
so
think
it's still kind of data is not so great, therefore they're actually going to have to cut more than now we were thinking. So it's like a catch-22 now.
It pretty much is. What the market has priced in is all of a 16% probability for another 25 basis point cut at the end of January. I think to the extent that Powell is reticent to talk about things like tariffs, things like the national debt, which he has not wanted to.
Which he won't.
He won't. He won't. But given the 2018-2019 playbook, we know that inflation didn't show up for a good 12 months, and that incoming Treasury Secretary Scott Bessent has said he wants to go more slowly than Trump 1.0 tariffs in terms of how they're pushed into the economy. There's so many things that remain to be seen, and you can never tell whether or not it's Bessent we can take for his word or not, because you just need a hot mic.
You don't know.
Trump.
Yeah, that's how it could go. Danielle, thank you so much for joining us. Danielle DiMartino Booth. She's the CEO and Chief Strategist at QI Research, joining us here in our Bloomberg Interactive Broker Studio. And the 10-year Treasury, pretty flat today, sitting right at 4.4% today. So again, the timing here, folks, the Fed will release their statement 2 p.m. Wall Street time, and then there'll be a press conference at 2:30 p.m. I believe in Washington, D.C. Michael McKee, Bloomberg's Michael McKee is there. He hopped on the Acela, and he's down there. We'll have Bloomberg TV and radio coverage simulcast with Tom Keenan and the surveillance team starting at 1:30 p.m. time, Wall Street time. So we'll have complete coverage there.
So, okay, Mike actually flies.
I know.
I don't understand that.
Well,
I would do the Acela, but that's what he does when he goes to D.C., just
yes,
putting it out
but
there.
he trains it to Boston, though.
Yeah, it is
I do the exact
right?
opposite.
I would just train both ways.
I think I'm going to start training to Boston, but my whole life I've always flown to Boston.
Right.
But if the wind wisps just a little in the wrong direction, they shut down Logan for
And LaGuardia, so you're good.
Yeah.
So you're not good, actually, and
No,
you should definitely use the train. That is just our commentary, and it's important that we know that.
But they've redone the Boston airport, so I don't mind. Because
nice.
United used to be a dump back in the day.
And now it's a little bit better.
Yeah.
Okay, so we're looking forward to the Fed meeting. Skip, hold, or pause. Apparently, those three things are different. And if we forecast one of those three things, that will have a different reaction function. Also, does the reaction function change based on the policies coming out of the White House and how that manages for the market? All right, coming up, Patrick Clark of Bloomberg will be joining us.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday. Happy Fed Day. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Also check us out on YouTube. So here's an article for you, and I feel like I've been waiting for this headline for a while. Office real estate is facing a year of reckoning in 2025. I know Paul definitely has in his bingo card. Well,
Yep.
Which building are you looking at?
The lipstick building.
The
on
lipstick
Third-
building, like,
Third
like
Avenue.
what that's going to rephrase that.
Yep.
That's what he's looking at, and then the discount. So is next year going to be the year? Patrick Clark, Bloomberg real estate reporter, wrote this piece. Okay, we've been waiting for commercial real estate to really fall out of bed. Why is next year the bet?
Well, it's just these things take time. It's like a slow grind down, just in the way that post GFC, you know, the delinquencies and defaults really didn't spike until, or didn't peak until 2012. It takes time for the stuff to work its way through the system. Everyone's running out of patience a bit, like on the lender side. You know, the extensions no longer come free, and they might not come at all at this point. So part of it is that I think the one thing that's changed is a year ago, people might have expected we were going to get 6 or 7 rate cuts this year, and now that, you know, those, not only did those not happen, but we don't expect them next year later. So you can no longer sit there hoping and expecting that interest rates are going to save you. So you kind of got to make a decision.
So how does this come about? Is it in terms of, oh my goodness, the equity folks have to write down the value of the building? That not only, or usually happens when I've got a loan coming due and I've got to renegotiate it, and then I've got to get a determination of the value of the building, or the lender will put a valuation of the building. Is that typically the precipitating factor?
Yeah, I think it's, you know, it's the maturity wall. As you're, you know, it comes time, you have to pay off. There's a big, almost all of these loans have big balloon payments at the end of them, and you got to pay them off. That means you got to get a new loan, and that becomes, and the new loans have not really been available, and we're certainly not available at pricing that would be tolerable. And so that's where the negotiations come in, and I think the way those negotiations have played out over the last 18 months have been, let's kick the can down the road.
Extend and pretend.
Extend and pretend, or sometimes the cleaned up version of that is amend and pretend, which means you actually have to put something in to get the extension. But again, it's like the extensions are a little, they become harder and harder to get over time, particularly as this hope that there's going to be an event which makes all the problems go away and dissipates.
When is the maturity wall sort of coming up? And I appreciate it's probably property by property. And who takes the hit?
The maturity wall is, you know, it's permeable, right? Things pass through it. In some ways, you know, the one thing that happens when you extend loans is that you add them to next year's maturity wall, and so the more loans don't pay off. And I saw a stat. I don't think we got into the story, but something like, you know, it's only like a quarter of central business district office buildings that are financed in the CMBS market have paid off at maturity over the last 3 or 4 years. So it's like a lot of them are they're pushing out. They're pushing out, and that just makes the maturity wall go higher. Now, they can continue to be pushed out until they can't, and we don't know exactly when that moment will hit, or you know, like with what force or with what volume.
Right. Is there any sense that we're hearing more, I'm not going to say more and more, a sprinkle of companies are coming saying we're getting people back 5 days a week. And I wonder if that's being perceived by the commercial real estate market as, all right, maybe the worst is behind us in terms of vacancies and that kind of thing. Is there any discussion in the real estate business that maybe just the business fundamentals have bottomed?
I think, yeah, sure, yes. And but in some ways, I think that is more of a catalyst for resolution of these situations, is sort of like, we know what it is now.
Yep.
It's not great. It's great if you own One Vanderbilt, right, or a, you know, a brand new high tech office building, 731 Lex. But the you know, if you own commodity office in you know, in the Garment District or something, it's that's you know what it is now, and it's not great.
Right.
I'm just wondering, is it big banks that have a lot of these loans? Is it small guys? Like, where do we see the ripples?
Well, I think that one of the things that I think we've seen happen is that the bigger banks that are in, you know, better situations across their business have been able to and have been reserving at a faster, at a higher rate. So they are, they've been quicker to acknowledge the issues and to prepare themselves to ultimately realize losses, whereas smaller banks, we've seen much less of that. We reported I think the story ran on Saturday, we're starting to see smaller regional banks modify loans at a greater pace, which again, I think we see as like a greater, they are pretending less, right?
Mm-hmm.
They're
extending and pretending less.
Well, they're pretending less anyway. Like they're acknowledging, yes, okay, like more stuff is still yet to happen. We can't just push these things out. We have to get ourselves in position. But nobody wants this all to happen at once, right? I mean, it's in everyone's interest for these problems to be realized, gradually and at a pace where they can kind of be controlled.
All right, Pat, thanks so much. Appreciate it. This is an ongoing issue. We're fascinated by it. We continue to see stories, periodic. Like I saw the B of A building in LA a couple of weeks ago. That traded hands at like a 50-60% discount. I mean, this is a central Los Angeles downtown corporate tower. So we're starting to see some of those stories hit the tape. Pat Clark, real estate reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Brokers studio. Looking at the markets here, a little bit of green on this screen. Not going to oversell it. Market probably waiting for what we're going to hear from Fed Chairman Jay Powell this afternoon. S&P 500 up about 0.3%. The Nasdaq up about 0.25%. 10-year Treasury, you can get about 4.4% on a 10-year Treasury today. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Wednesday, happy Fed Day. Alex Steele here alongside Fed Sweeney. This, Fed Sweeney? I just called you Fed Sweeney.
Nice.
Nice. I don't know what that meant. It's just Fed Day, and so, Paul's Fed. All right, anyway, Paul and Alex, we are here on Bloomberg Intelligence Radio. We have a great hour lined up for you. Clearly, we're going to talk about the Fed and some of the individual stocks that are moving, but also what's happening over in D.C. So apparently, Elon Musk comes out against the Republicans' deal to temporarily fund the government. How does that then move as we try and get the government funded through Friday? That's kind of the deadline. We're going to break all that down for you. Ira Jersey also is in-house. He will help us break down the Fed as well. And Peter Cheer, one of the best, honestly, on the street, head of macro strategy at Academy Securities, will be joining us in just moments. But let's kick it all off for you here with the Business Flash is Charlie Pellet.
All right, thank you very much, Alex and Paul. We have got the Dow, the S&P, NASDAQ in the green as investors brace for the Fed's final policy decision of 2024, the final countdown. Cue the music. Its outlook for next year as well. That's coming up at just about exactly 2 o'clock Wall Street time. Complete coverage right here on Bloomberg Radio. And, of course, Jay Powell's news conference, 2:30 p.m. We got you covered on Bloomberg. S&P up 17. Gain now of 0.3%. We got the Dow up 224, up 0.5. NASDAQ up 60 now, a gain of 0.3%. The 10-year on this Fed Wednesday, 4.39%, with the 2-year 4.22%. Gold now down $10 the ounce, 26.36, drop there of 0.4%. West Texas Intermediate crude up 1.4%, 71.04 a barrel, and Bitcoin now at 104,000. It is down by 1.9%. So what about the market backdrop? Cameron Dawson is Chief Investment Officer at New Edge Wealth, and this morning on Surveillance, she told us, yes, it's a great bull market, but with an asterisk.
Well, I would define the great bull market as the great bull market for a few, meaning that if you look mostly in the last couple of weeks through the last month or so, you have seen a big deterioration in the average stock. You've seen the S&P equal weight only up 0.3%. Compare that to the Mag 7 up 15% in the last month alone. So it is a bull market, but it's certainly not a bull market for everybody.
Cam Dawson of New Edge Wealth. You can hear more of the conversation conversation on the Surveillance podcast, and you can download that wherever you get your podcasts. Honda in talks to come to the aid of Nissan Motor by potentially forming the world's third largest car maker in order to better withstand escalating challenges for the global auto industry. Now, as sources told Bloomberg, the two Japanese manufacturers have engaged in merger discussions that appear to have accelerated after Hanhai Precision Industry, the Taiwan producer of iPhones known as Foxconn, approached Nissan about acquiring a stake in the company. So right now we do have shares of Honda down 3.1%, ADRs of Nissan, they're up by 16.8%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube as well. So you can head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Let's get a look at what's happening under the hood in these equity markets. Bloomberg's stocks reporter, Bailey Lipschultz, joins us here in our studio. Bailey, what are you looking at?
Yeah, starting with the best performer in the S&P 500, that is Jabil Inc., ticker JBL, right now up 8.9%. Alex, before you ask me what they do, they are a manufacturing services company. They operate in appliances, automotive, packaging, photonics, transportation, a lot of things.
Awesome. Thank you.
Yeah, see, you always ask those questions, and then I have to hurry up and find out what they do.
That just makes me sound dumb. But
no,
okay.
I didn't mean it that way. Because these are companies that I feel like a lot of people are typically not familiar with.
They do all the stuff.
They do a lot of stuff. Using Sweeney's function, supply chain SPLC, Apple, Amazon, Johnson & Johnson, Tesla, Volkswagen, in a lot of places. Beating expectations, raising their revenue forecast, providing a bit of a boost to peers like Flex and Semina. Big thing when you look at kind of beating expectations, they called out cloud data center infrastructure and digital commerce. Those are areas that, at least in the new issue market, everyone wants to talk about data centers and cloud computing. So definitely playing to the trends is Jabil, ticker JBL, again, up 8.9%.
What about the managed care guys? So this is kind of interesting, right? Because CVS is higher by 5%, but they've been hit pretty hard with the worry that President Trump is going to interfere with the PBM model.
Exactly, and that's why we're seeing kind of the broader group, as you mentioned. When you look at what we're seeing today, top performers in the S&P 500 right behind Jabil. Cigna is second, up 5%. CVS, to your point, up 4.7%. Humana up 3%. United Health as well, up 3%. When you look at it from where these stocks were trading 2 weeks ago, CVS is still down 20%. Humana is still down 16%. So it could just be buying the losers. Yeah, exactly. And the big thing, having covered healthcare for the first half of my Bloomberg career, there's a lot of rhetoric around presidential elections. And there's a lot of uncertainty. And when this uncertainty happens, you see stocks either rallying or selling off. And then it becomes a question of, is that when Trump comes into the White House, is PBM first, second, or 20th on his to-do list? And if it's further down, that creates a buying opportunity for a lot of the specialized funds.
Just got a red headline crossing the Bloomberg terminal. The Supreme Court will hear TikTok challenge to U.S. bans. That's just crossing the tape. We'll have more reporting on coming up on that soon.
Yep. So remember, come January 19th, the ban on TikTok will come into effect. So if you're an app or you're a server, you're not allowed to have TikTok on that. And if you do, then you could be up for some serious fines. Now, President Trump has not taken a firm stand today on TikTok. He said he'd take a look at it. He obviously takes office January 20th. So this is sort of like a stay of execution for TikTok to see how President Trump will come down on it.
And Matt Schuttenhelm from Bloomberg Intelligence, I think it actually assigned a fairly low probability to the Supreme Court hearing this. So this is a little bit of a surprise.
Yeah, it is interesting to see how that will definitely pan out. We will track that for you as all of this crosses. One more to hit here. General Mills, the outlook was weak, right? But is it also bringing down its peers, or do we get the feeling it's a General Mills specific story?
No, exactly. We're seeing the S1500 packaged food index, S15 pack on your terminal, down right now 1.5%. So when you're looking at the worst performers today on the flip side, in the S&P 500 broadly, General Mills, Campbell's, Kraft Heinz, Hormel, we're seeing Hershey under pressure, WK Kellogg under pressure. Investors are, again, maybe a similar thread to what we saw with managed care names rotating out of it just because of uncertainty around if you can't continue to hike prices and you do see consumers increasingly shifting down. Inflation fears are still top of mind. A lot of uncertainty on the consumer side of things. So it could just be a kind of rotationary trade. Again, top performers in the day, some of your worst performers on the flip side, those kind of consumer staples, packaged food names under a bit of pressure after General Mills.
All right.
Yeah, awesome.
All right, Fed Sweeney, you good?
Yes, I'm good.
All right, this is your name. All right, Bailey, thanks a lot. Bailey Lipschitz is joining us, Bloomberg equities reporter, senior equities reporter. All right, joining us, the man. He is fantastic. He knows things about everything. He has opinions on everything and really good insight. And he's the kind of guy where you don't hear what he says anywhere else, and that's really special in this kind of business. Peter Cheer of Academy Securities is joining us in studio. Peter, how are you going to be reading the Fed today and then the market reaction to the Fed today? What's going to be your takeaway come tomorrow?
You know, I'm really expecting a fairly hawkish Fed. I think they are a little bit worried about the economy, but it's not showing up in the data, so I think they're going to have to come across, hey, we're potentially on hold. We've done 100 basis points. Let's see where this plays out. I think that will disappoint the market a little bit, only because we are up so high since the election. Everything's run. I think people got very comfortable. Rates are coming down. I think that stops. I think I'll be paying close attention to the summary of economic projections, or more likely the dot plot, where do they take the terminal rate, and does that move closer to 4%, which would signal that, yes, they are very close to being done.
If the Fed is going to be slower than expected in lowering rates, if not coming to a pause here for maybe all of 2025, can the stock market work in that environment?
I think so. I think the stock market has really moved on to what is Trump going to do? What's Doge going to do? Where do we head from there? And I think there's a lot of optimism. I think, once you move past some of the fears about tariffs, which I think people have kind of fallen into this, maybe a bit of a false sense of security right now that there are negotiating points, I think this is really going to be about, can he do something about the rules and regulations? Can we revisit 20 years of rules and regulations that have been put in place when they had the luxury of being the sole superpower? And now that we're really competing economically with China and the world, do all those make sense? And, we've talked more recently, we went from drill, baby, drill to refine, baby, refine. And I think the one thing this economy really needs is to process rare earths, critical minerals, energy products ourselves.
So to that point, do we need to rethink a reaction function to the Fed when we don't know what those policies are going to be?
Yeah, so I think the Fed's the reaction's probably going to be fairly mooted one way or the other day. Like, we'll get a bit of movement.
Because he's not going to take the bite on anything that has to do with D.C.
Right, and he's going to, we have to wait and see. And again, I think, as the last guest just pointed out, we don't know what's actually going to get implemented day 1 or day 2 or day 3, what's going to be a priority, what falls through the cracks. When I look at it, I think immigration, they're going to go after some highly visible targets that probably most people are in favor of. I think you've already seen New York City Mayor Adams start talking down. So I've always thought the Roosevelt Hotel, that type of situation is going to be the first thing they crack down on, but it's not going to bleed into this wholesale, knocking on doors, kicking in doors, pulling out people and sending them away from the country. So I think that'll be fine. I think in terms of energy, he's going to start enforcing some of the sanctions against both Russia and Iran, partly to force them to some sort of peace deal, also to support our own energy industry, and from there we'll just see what comes up.
What he comes up with, yeah, that'll be interesting. It always is. For those of us in the news business,
yeah,
keeps us on our toes.
Okay, so what do you do? So what do you like? So we're looking at the risk of higher yields than for next year. I'm reading between your lines. We're still talking about that bad breath in the market and the leaders from the NASDAQ 100. What do you do?
So I really like, they've been selling off again, but I do like all the commodity players, all the industries that enable commodity. I really think there's going to be this massive push for some sort of, let's call it security broadly, where we need to produce and refine our own rare earths, critical minerals, and energy. So I think we talked about energy. So I don't think it's really going to be good for the commodity prices, because I think you're going to see more supply come on. But I think you're going to see these companies embrace it. I think you're going to see a big push to create some regulatory, opportunities. And one thing, one of our generals is really keen to point out on, he was very involved in Trump's first negotiations with Xi on tariffs. And Trump feels a little bit cheated by Xi, because Xi had promised to buy a bunch of agricultural products and never followed through. So if there is a deal this time, and I assume there will be one, watch for ag to really benefit, right? He is really going to force Xi to buy it and deliver on that purchases this time. So I think, again, that whole industry. So I look at all the heavy equipment manufacturers, they should do really well in that environment, and they still trade cheap, right? Yeah. AI, some of these others may do very well, but they trade very expensive. This, to me, it feels like it's going to have to catch that momentum, and you're going to have to get that inflow. But if you get those inflows, there's a lot of room for these stocks to run.
Just asking for a friend here. What do you think about the energy space here? Because if we're drilling or refining or whatever, I think that's good for the energy space, but maybe it could not be great for prices?
That's it. I think it's not going to be great for prices, so that'll be a slight, impediment to real growth. But on the other hand, I think he's going to reopen up our ability to export, right? He's going to create these opportunities. So I think our companies will do very well in this, and I think the energy stocks will way outperform the commodities. So I see an environment where the commodity prices may be stable, slightly down, slightly up, depending on what goes on in terms of economic growth, whereas the stocks can rally 10, 20, 30% even with that.
Yeah, and then to that point, I mean, that's kind of what we saw today, that the idea, well, actually reporting from Bloomberg, is the idea that they're going to roll back the EV incentives, but they're going to put more money and stuff in those 100 days into creating the nuts and bolts of how to make those EV cars, like critical minerals and stuff like that. So that's exactly to your point.
Yeah, and the one thing I think we all forget, and I have to remind myself too, is producing and refining commodities is commodity intensive, right? As we build this out, you need steel, you need pipes, you need roads. So it's all very commodity intensive. So that will support the price of commodities as we build this out. And I just don't see any reason Trump won't push for this. I think it's good from a national security standpoint, and it's the sort of thing he likes doing, right? He loves cutting red tape. That's what he did. Whether he's a businessman or more marketing, he loved cutting red tape. So I think this is going to be something that really appeals to him, to Musk, and it's going to be relatively easy for him to get through in many cases.
Also, this is like perfect for Musk. Like if you create a factory that you can source all your critical batteries for Tesla, cool. I mean, that's what he's been trying to do anyway when it comes to Tesla.
Yeah, and just even from a military standpoint, the amount, they had to rip out, I think, a lot of the Huawei chips that were in our military equipment, right? But some of the raw, the rare earths, critical minerals, the refined products are coming from China. Why? The person that we're having the most degree of friction and potentially at most risk with down the road, you would not be wanting anything that goes into your military equipment being sourced primarily from there. So I think that's all going to get changed. It's all going to get pushed. And I think this time what I have liked is, we're calling it Trump 1.5. He's hit the ground running, right? He's already effectively getting stuff lined up to do, unlike the first time around where I think he was kind of a little bit deer in headlights and didn't know what to do day one.
Do we have those rare earths and the minerals and the stuff we need for electric batteries? Do we even have that here in the U.S.? I thought they were in other parts of the world.
There actually are a lot in the U.S. So I think, one of the, as governments built out, some of you got rid of the Bureau of Mines. We have not been big at mining things. One story we've heard that seems pretty interesting is where there are a lot of the fracking was done, the water that stays in the ground has actually been absorbing lithium. And so you can extract that water from the evaporate and get lithium. And that's actually probably the most efficient way to do it. So there are all these opportunities, but I do think the big thing is going to be the refining. So I think to me, right, there are other places in the world we can get the resources themselves from, but how do you refine them? We have to take that responsibility on ourselves. And I think the process has never been green, but the reality is if you let China do it all, it's not green. It's probably not even as green as they say it is. So take that responsibility on your own, do it here, do it domestically. So that's why I think I'm switching more and more to refine, baby, refine from drill, baby, drill, because it's all going to be about the processing.
Smart. Yeah, so smart. Also, you remember we used to book Peter as the bond guy and like, look at how far you've come. So let's talk about bonds though. What do you think we're going to see on the 10-year? And I asked that because T. Rowe Price said we could see 5% in the first quarter of next year and then 6% next year. You think you're going to get a hawkish Fed anyway. And there's going to be all this investment that we're talking about and going through, which could be lead to a lot more growth. What do you think?
I'm not quite that bearish. I think we should be around 440 to 460 on 10s. I think, post-election, everyone got too bearish, so that was an easy call. We got the retracement back down to 415. I've been bearish since then. I want to see, I think, coming into year-end, 440, 460. I think there's a much bigger risk of a gap 50 bips higher than a gap 50 bips lower. I think we've had those moves. Yeah. And I could see us getting to 5% next year. I struggle with 6%. I just don't think the economy is going to be that good. I think enough people pile into duration at that 5% level. So, and we've kind of for the last 2 years been making lower highs on yields. Every time we sell off, it's not quite as bad as it was before. So I think I'd probably, unless something dramatically changes, I'd be a big buyer of 10s if we got to 5.
Credit risk? Taking any credit risk out there?
Yeah, we've been slowing down. I thought credit was great. We've loved it since June. I'm kind of more neutral on it. Part of what I saw, I think that was really positive was a lot of banks had not lent enough during the post-Silicon Valley Bank, so they were chasing money. Private credit was getting a lot of money, so all this was coming into the markets. So I've liked credit, and I think we're okay there, but I do think if the economy slows a bit, some parts might do less bad. A lot of things was very dependent on getting, lower floating rates. I don't think we're going to get that to happen as much. So I'm like neutralish. I don't see anything wrong with credit. The one thing I will say is I find myself fighting with people on high yield a lot. People keep pulling up these charts of high yield bonds and, oh, look at how tight they are. They're too tight. And to me, the high yield bond market does not look anything like it did 10 years ago. So close your eyes when you pull up these long-dated charts on the high-yield market. It used to be smaller companies, not well-known. It's a much better market.
Yep, very good. Peter, another great performance. Thank you so much. We appreciate it. Peter Cheer, he's had a macro strategy at Academy Securities. Academy Securities, for those of you who don't know, the founders, military. So a lot of the leadership and the ownership of Academy Securities is ex-United States military. So some good folks over there, and we appreciate getting some of Peter's time. S&P, we're up 4.5 points. How about that? This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Our top story, as we have been reporting, the U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the social media app if it is not sold by its Chinese parent company. They have scheduled arguments now for January 10th. TikTok and its parent company, ByteDance, say that law violates the Constitution's free speech protections. Two other developing stories at this hour. Russia is moving advanced weaponry from Syria to Libya, that according to the Wall Street Journal. And Barclays' annual bonuses are expected to increase as much as 20%. U.S. stocks right now, little changed, with the S&P up 3, up less than 0.1%. We do have the Dow up 119, up by about 0.3%. NASDAQ in the red now, down 4 points, a little changed. The 10-year yield on this Fed Wednesday, 4.39%. The 2-year, 4.22%. Spot gold down $8 the ounce, down 0.3%, 26.38 on the precious metal. West Texas Intermediate crude up 1.8%, 71.33 a barrel, and Bitcoin now at 103,500. Also, cocoa soaring above $12,000 to reach a new record on supply fears. Again, repeating our top story, the U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the social media app. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pella, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. A lot of news coming out of D.C., so we need to go to our D.C. experts. It turns out they're actually here. They're not in D.C.
They were outside the studio, and I totally didn't make that connection.
Which leads me to believe that somebody is buying these two gentlemen cocktails this evening. That's the only thing that would get them out of their D.C. office. Matt Shettenholm, he joins us here. He covers all the litigation for the media telecom space for Bloomberg Intelligence. And Nathan Dean, Senior Policy Analyst at Bloomberg Intelligence, both here in New York City. Matt, let's start with you. I was surprised to see that headline that the Supreme Court will hear the TikTok challenge to the U.S. ban. Give us your thoughts.
This is amazingly fast for the U.S. Supreme Court. At this point, only TikTok had filed a single brief, just filing an application. Usually there's a process before the court grants review. None of that happened here. The court immediately entered an order saying, okay, the deadline is January 19th. We'll hear argument 9 days before that, January 10th. We grant review not just on the stay, not just on the pause of the law, we grant review on the whole case. We're going to take this up, this big First Amendment question, first thing in January.
So what do you make of that?
I mean, it's a good thing. I think it's a positive sign for TikTok that the Supreme Court.
But why was it so fast? Like, what does that tell us about something?
I think the Supreme Court sees a very serious legal issue that needs to be resolved quickly. You have the president weighing in on this question and a deadline that's looming, January 19th, of whether the ban is going to take effect or not. So I think the Supreme Court said, we need to take this. We need to take it fast. I don't think it necessarily means that TikTok will prevail, though. I continue to think TikTok probably has an uphill battle in persuading the justices that it's correct on the First Amendment. But at least we know TikTok will get the chance to present an oral argument to the justices now in January.
January 10th, they will present their argument. How long do you think the Supreme Court will take to then rule on it? Presumably before the 19th, right?
All of this is very unusual for the Supreme Court. We are in strange territory here, so I can't look at my statistics from all the other cases. I do think the court is going to try to address this by January 19th. What they could do is say, look, we'll issue an administrative stay to delay that January 19th deadline until we rule. But I wouldn't expect a major delay on that front. I think the court will try to resolve this close to the January 19th deadline.
Wow, I don't think I've ever heard of this for a court that moves quickly that's supreme. This is like truly shocking. It's an unfair question, but like, what's your best guess? Like knowing who's on the court, where they think and how they think about the First Amendment.
Yeah, so I continue to think TikTok faces an uphill battle with this Supreme Court. When you look at how the D.C. Circuit decided this, on a unanimous basis, where 2 of the 3 judges were Republican appointed. And now you take that same decision to this Supreme Court. This Supreme Court tends to nod its head in agreement with the rulings of Naomi Rao and Douglas Ginsburg, who decided this case in overwhelming fashion against TikTok. So does it mean TikTok has an impossible case? No, there's a chance it could prevail here. This is a novel First Amendment question. Lots of ways for the Supreme Court to rule for TikTok. But I think it's uphill for TikTok. I think most likely the Supreme Court says, you know what, the D.C. Circuit got it right.
Yep. All right, Matt, thank you so much for coming in last second here on this breaking news. Matt Shelton, he covers all the litigation across the media and telecom industry, which is a highly regulated set of industries there. All right, let's turn to the question of whether our government's even going to be open come January 10th or something. I mean, I put this all on Nathan Dean here. He's the senior policy analyst for Bloomberg Intelligence. Nathan, can you flesh out for us kind of the timetable? What is happening in government as it relates to keeping this government funded past Friday? What's the story?
Yeah, so obviously the House and the Senate both have to pass a funding resolution. This one would get us to March 14th. They got to do it by Friday night. Now, where we are at the moment, the text came out last night. Speaker Johnson is trying to sell this amongst his own caucus because this would originally go through the House Rules Committee. They've given themselves a 72-hour window to review legislation. Now, if they can't do it within that time frame, Speaker Johnson is going to have to put this on the floor, and he's going to need a lot of Democrats to go with him. So we have a 20% chance of a government shutdown happening Friday night, despite the fact that you have Vivek Ramaswamy and Elon Musk now coming into the conversation, because ultimately nobody wants to have a shutdown. Neither party wants a shutdown over the holiday break. You know, this is something that I think most people are saying, let's have this fight and let's kick the can to March and fight it out then.
Okay, so let's just get to the Vivek Ramaswamy and Elon Musk thing. So Elon Musk says he doesn't like it.
Yep.
What power does he have to do anything about it? And how do we think that Doge is going to interact with lawmakers?
Yeah, so this is he has the power of the bully pulpit. I mean, there's really
because he's not confirmed. He was not elected.
Well, and there's the Doge Commission, if you call it, I call it a commission because the Department of Government Efficiency is not a department in the U.S. government, and it will take Congress, because they have the power of appropriations and the power of the purse, to implement the Doge goals. Now, what he's doing right now is he's certainly saying, look, people should not vote for this bill. Vivek Ramaswamy just said, do not vote for this bill. But ultimately, it's going to be a lot of Congress and a lot of Republicans are going to have to decide, do we vote for this bill or not? Because as much as Speaker Mike Johnson says that this is just a pure continuing resolution, there is some additional funding in here that folks need, like $100 billion in disaster aid for North Carolina, $10 billion in economic aid for farmers. The Washington Commanders, RFK Stadium moves to, the control goes to the D.C. government. There's a lot in this bill. But I think, again, we're just going back to our base case scenario that nobody wants to see this happening right now. They're more than comfortable to have this fight in March, and I think that eventually Speaker Johnson will be able to convince enough people to do that.
When Elon Musk comes out and says, don't vote for this, do members of Congress take that to be President-elect Trump is saying, don't vote for this?
Oh, good question.
You know, I'm not sure if they'll take it as President-elect Donald Trump, but they'll certainly respect Elon Musk's opinion, and they'll certainly respect...
Which I don't know why.
And they'll certainly respect the power. Because
spaceships.
Look, you know, if you were to give truth serum to all the Americans that are listening on the radio right now, you say, do you think the U.S. government is bloated? Should it be cut? I think 99% of them would say yes. The problem is that you're talking about an institution that's been around forever and would require a bipartisan act to essentially cut. When they say things like get rid of the Federal Deposit Insurance Corporation, the FDIC, that requires an act of Congress. You're not going to get 7 Democrats to go with you on that. So what I think Elon Musk's and Vivek Ramaswamy's main play here is to use the bully pulpit and make this into a PR exercise. Their report is due July 4th, 2026. That's 4 months before the fiscal year is over and 4 months before the 2026 midterms. Congress is not going to be able to agree on any of those changes within the appropriations process within 4 months. I think this is Elon and Vivek really using the power of the bully pulpit to try and drive agendas here.
I mean, how do you make policy on that?
Well, it goes back to the time and time tradition of, you know, government shutdowns, leverage fights, and then at the last minute, things come together. So the way it works is, in the Bloomberg News, DC reporters like to joke, is when they get into this type of negotiation, no deal, no deal, no deal, no deal 1,000 times, yes, you have a deal, then you don't have a deal, and then eventually they come back and have a deal. And what's going to happen here is...
Yeah, but now you're adding in a bully pulpit.
Yeah.
That's, I mean, are they going to be in the room here?
Well, And that's why one of our key predictions for 2025 is you are going to have, I think, a major government shutdown. If you remember, in Trump,
You think in 2025 we'll have a shutdown?
I don't think so in March, but I think in the September 30th, if they kick the can to September 30th, I think you're going to have a major government shutdown. Major being probably 2 weeks or more. If you remember in the Trump 1.0, President Trump had a 31-day shutdown, no risks to companies or anything like that. In fact, the S&P 500 went up during that shutdown. But for those people who rely on the U.S. government for contracting and employment and so forth like that, because we're entering a period where both sides feel comfortable about their positions, and that's where both sides say, you know what, we'll shut it down and let the American politics play out.
Wow. I mean, being the Speaker of the House, that's not an easy job. I mean, these guys, every time that we have to deal with this thing.
Well, that's a good point.
And now I've got these guys, from the cheap seats, weighing in.
Yeah, and I would just remember that Speaker Mike Johnson does not have an assured position going into 2025. I mean, he's only going to have 220 to 215, and with Matt Gaetz retiring and 2 members joining the cabinet, he's only going to have a 2-person majority. Now, we could see a Speaker of the House fight if Elon Musk were to tweet out and say, you know what, I don't think Speaker Mike Johnson should be Speaker anymore. You're certainly going to have a debate over that.
Well, that's what I'm saying. It's like, how long is Mike Johnson going to have this job? Just ask Kevin McCarthy how that goes.
Yeah, I mean, when Kevin McCarthy left, there were a lot of people in Washington who were just like, look, who can have this job? It's ungovernable. But Speaker Johnson, to his credit, was able to take the Republican Party through the tail end of 2024. And it's much different being the party in power, especially when the president is of your own party. And a lot of this is just going to be up to President Trump.
All right, let's assume I'm an optimistic person by nature, glass half full by nature. Let's